policy rate is likely at its peak for this tightening cycle. It will likely be appropriate to begin dialing back policy restraint at some point this year.
I think this is a signal, and the market is taking it as that they will tolerate slightly higher inflation for longer.
So yes, they have to tolerate a little higher inflation in the near term, but I don't think they're giving up on that 2% goal.
I think this is a Fed that really wants that soft landing to continue.
So we still think we're going to cut rates this year. Timing's uncertain, and he said over and over again, it depends on the data.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Well, that was fun. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Your equity market on the S&P 500. Record highs at a close yesterday. We had some weight to that rally this morning, up 1/3%. The biggest takeaway of the last 24 hours following Chairman Powell's news conference. Citi's Andrew Hondenhorst. Here's the quote, Lisa. Stronger inflation won't stop rate cuts.
This is a Federal Reserve that wants to cut rates, and the recent hotter-than-expected inflation data has not stirred them from that path, and that really is the message that the market is hearing loud and clear.
Two developments for me in the market, and you can take your pick on what stands out for you, but two for me. Equity markets all-time highs at a close yesterday on the S&P 500. Seen a few of those. Gold through 2,200 for the first time ever. What do you think gold is picking up on following yesterday?
Either it's an inflation hedge, which is what people are looking for, or it's been sort of a steady march higher. And this raises this question, the end of tight monetary policy, if you can call it that. A lot of people do. Tight monetary policy means that real assets have more value again, given that interest-bearing assets aren't going to be as interest-bearing going forward.
The inflation trade just creeping back in just a little bit more in the last day or so. Lisa, we had some questions for the Federal Reserve Chairman. Has he gained confidence? Has he lost confidence following those hot CPI and PPI prints of the last couple of weeks? The answer to that was basically neither. Basically neither, unchanged. He referred to them as bumps, basically looked through the recent inflation data as bumps in the road and said almost explicitly the story hasn't changed.
Ultimately, this was a Federal Reserve that had some changes and didn't explain any of them. He said a lot of words, but didn't really have a different message, and frankly, didn't even have a cohesive story to tell, other than we're making progress, we're going to be patient. And you know what? If it takes time to get down to 2%, we're okay with that because it will get down there. And to me, this is really the ultimate sort of turbocharger to stocks. This is a Federal Reserve that will prioritize a soft landing over inflation data that is bumpy, that is causing some agita in certain corners.
So the bumpy road to 2%, let's talk about that commitment to 2%. This is just one example of maybe accepting slightly higher inflation. But if you go through the forecast, we had a big upgrade to GDP, a slightly less as big upgrade to inflation. Now, they can make the argument that maybe on this occasion strong growth isn't the problem. But if you repeat that in June, then we've got much, much bigger questions about their commitment to getting back down to 2%. I think they can have a one-off excuse this time around. I don't think you can repeat that in quite the same way in a few months' time.
Which is the reason why there still are the no rate cut people out there who are saying they want to cut rates, but they're not going to be given the privilege to do so. And this is really ultimately the question of when do the data points become more than noise? And right now, it seems like the Fed is dismissing them as noise. The market, maybe not, but they're taking the message loud and clear that the Fed isn't going to take it seriously until we get some more months. And this is the reason why data dependency is so difficult. It's like, how many data points do you need to be dependent on those data?
Do you want some rate cuts? Head to Zurich, Switzerland. Surprise 25 basis point cut. Much weaker Swiss franc overnight. Dollar Swiss pushing 90 now on my screen, that currency pair breaking out by about 0.8%. So I know I refer to them as second-tier central banks, the likes of the S&B, the BOE, but you're getting a flavour for what other central banks are doing this morning.
They're trying to get ahead of any move from the Federal Reserve or the ECB because they want a weaker currency. They want a weaker Swiss franc. And to me, this really raises the question, will the second half of 2024 be the race to cut? Essentially, how do you cut first and get ahead of the others so that you can carry the benefits a little bit of being a market leader and, frankly, edify an economy that otherwise could be beset by fears of a hard landing?
We've got a lot to work through this morning, so let's get to it. Equity futures on the S&P 500 positive here by 0.3%. The equity market doing better than okay. Yields down again by another 4 basis points on a 10-year, 422.75. And a euro just about unchanged against the dollar, 109.17. Coming up this hour, Chris Ferro Strategas as the Fed fuels stocks to fresh all-time highs. Bloomberg's Craig Trudell as the Biden administration relaxes EV rules, making some room for hybrids. And Ian Steely of JP Morgan on the Fed's path forward, and if the call for 3 cuts this year will shift to 2 or even fewer. We begin with our top story. The Fed fueling global stocks to all-time highs. Fed Chair Jay Powell and company sticking to 3 cuts for the year despite a string of hotter-than-expected inflation prints. Small caps posting their best day in a month, with gold running above 2,200 for the first time ever. Chris Ferro Strategas, a Baird company, joins us now for more. Chris, buddy, let's get to it. Gold. What is that breakup in gold all about, going through 2,200 for the first time ever?
I mean, John, when you look back at the sequence of events the last several weeks, let's first go back to January, February, when you had that decisive move in gold through 2,100. And then what we found really notable these last 2 weeks, as bond yields pushed back higher, right? You had yields go from 4 back to about 435. Gold didn't flinch. It was a very orderly pause. The title of our client note this morning is Gold knew, right? Gold knew we were going to get that we were going to get a dovish Fed yesterday, and I think certainly the response speaks to that here. I think the backdrop here remains very bullish gold. It remains bullish metals. It remains bullish materials. We see that with the expansion and new highs in things like copper, Freeport-McMoRan, the material stocks, etc.
Chris, watch what they do and not what they say. When you look at what they're actually doing, not what we were told in the news conference, is that a Fed that's signaling they're going to tolerate higher inflation?
Well, I think when you look at the tone of really global bond markets over the last couple months, I think the bond market is set on the idea, almost regardless of where some of the near-term inflation data comes out, these are global central banks that are going to cut. I mean, we see the move in Swiss overnight. The Swiss bond market's been telegraphing this for weeks and weeks and weeks. The Swiss currency's been telegraphing this. I think when you look at things like UK 10-year yields, they've rolled right back over. German 10s are still below the 200-day. So the global picture from bonds, I think, supports the idea that almost irrespective of where the future inflation data comes in from here, you will get central banks cutting this year.
Just to put a bow on the idea of why there is so much demand for the likes of gold and some of the metals that you're talking about, is this a trade on the idea that maybe inflation is going to run hotter in the future and this is a good hedge against that? Or is this a trade that a Fed and the rest of the central banking complex cutting rates will support growth and some of the demand for these assets?
I think it's a little bit more of the latter, Lisa. We've used this term fiscal dominance to describe why we think gold is in this bull market, which basically implies the central banks have to ease given the position that the sovereigns are in really across the world. Now, anytime you see gold break out, your mind does begin to wander. Is there something sinister or something ominous on the horizon? I think if gold was trying to communicate to us that there's something nasty out there, we would also see it in credit conditions deteriorating, which we have not seen yet. We would see it in weakness in financial sector stocks, which we certainly have not seen. Yesterday was one of the best new high readings in the financial sector that we've seen in months and months and months. So I think gold is more about the position the central banks are in relative to where their fiscal counterparts are, as opposed to some real ominous message about economic growth down the line.
Given that, it's understandable why there's so much momentum and so much money just flooding into the trades that have done best so far this year. At what point do we have to worry about the fact that we have an economy that's being turbocharged by fiscal money and a Federal Reserve and other central banks that are poised to ease monetary conditions to the tightest levels in decades at a time where we're not seeing those real signs of weakness that could potentially curtail any upside surprise?
Well, it's funny, Lisa, we always talk about or kind of make light of everyone has all these fancy liquidity models. I mean, the only liquidity model anyone needs is the price of gold or the price of Bitcoin. And I think that tells you everything you need to know about the liquidity environment that we continue to deal in here. Now, what's been a little bit ironic is despite this just ripping move higher in gold, the paper market, the flows have basically been non-existent. The flows into the GLD are very, very modest, certainly compared to where we have seen gold top out in the past. So I don't think sentiment is that huge threat yet. Your question also alludes, I think, to a longer term idea of at some point, does growth ultimately begin to slow? I think if that's the case, we're going to see it in a change in equity market leadership. I would expect to see things like industrials deteriorate. I would expect to see consumer discretionary begin to weaken versus consumer staples. There's just not a ton of evidence of that yet. So for lack of a better term, we still, very much seem to be in this sweet spot where you have bond yields that likely don't run away from us, dollar that doesn't run away from us. And I think gold and copper and discretionary and industrials all reflect that.
Chris, let's talk about leadership in the equity market. Usual suspects yesterday, top of the pile, discretionary, communication services. Energy actually lagged. You seeing any signals that maybe energy can take the baton from big tech?
Well, I think there's a couple of important things going on. And you mentioned energy and materials. I wouldn't call them leadership, but John, they're not going down. And when your laggards are at least going up in price, it describes a pretty full environment where there's lots of participation. I mean, we're still sitting here 3.5 months into the year, and 80+% of the S&P is above the 200-day moving average. So it's still pretty broad by almost any metric. Now, something we always like to do in our work is look at what the consensus perceives to be the weakest group, and then simply ask, is it behaving as if it's the weakest group? And I still think, just from our meetings and our conversations, the consensus believes that commercial real estate and regional banks will be the source of any new stress or trouble. But when you look at the charts, they're just not that bad. The bank stocks are still pretty well bid here. The regionals certainly moved yesterday. The REITs, frankly, trade pretty well, or certainly trade along the idea that you will not get bond yields running away from you here. And I think that's the big key. Like our thinking, our approach certainly would have to change with 10-year yields above 450. That's just not our base case here.
So are you a screaming bull, Chris?
I'm certainly bullish. We've been bullish. We remain bullish. I think the changes to that, if there's a problem that's brewing out there, if there's something sinister, I think it's too early to know. And I think importantly, Lisa, we would see it in really degradation or deterioration to the leadership fabric of this market. And that's largely been intact for the last year. I focus on things like, is discretionary still outperforming staples? Are industrials continuing to set the leadership tone of this market? I think so long as those boxes are checked, we're in this status quo environment. Now, you always have to be on guard for things that could change your view or upset that. Maybe it's oil to 90, maybe it's rates to 450, but neither are our base case here.
Hey, Chris, good to catch up. Chris Ferro, a strategist. For so many, that was just a green light in that news conference to buy equities and buy pretty much everything. Bonds rallying as well, gold rallying too, everything rallying against the US dollar in foreign exchange as well. Let's give you a snapshot of some of the feedback that we've got on the south side. Pantheon Macro, recent inflation data, just a bump. Capital Economics, Fed still on track for a June rate cut. I mentioned Citi earlier, worth repeating. Rate cuts are coming even if inflation or growth runs stronger than expected. We were trying to work out how would the recent data change the story at the Fed. Hasn't changed it at all. In fact, Chairman Powell said a few times in that news conference, story hasn't changed.
Which raises the question, at what point do inflation concerns become a threat again? Or does the market buy into the idea that the Fed does, that growth is not going to cause inflation to materially increase, that it actually is compatible to see inflation come down, even with strong growth that could potentially even reaccelerate, especially given some of the optimism that we're hearing from everyone across the board?
That's a conversation we need to have a little bit later this morning and throughout today. Equity futures right now positive by a third of 1%. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The Swiss National Bank cut its key interest rate by 25 basis points, acting months ahead of the Fed and ECB. Officials lowering their benchmark rate to 1.5%. Some investors were betting on a cut, but most economists predicted the rate would stay unchanged until at least June. The franc tumbling after the decision, falling 1% against the euro to its weakest level since July 2023. Job cuts are coming at Barclays. Bloomberg has learned the UK bank is preparing to cut several hundred jobs within its investment bank. The move comes as the firm embarks on a years-long effort to trim costs and boost profits within the unit. Astera Labs surged in its trading debut, marking the best first-day gain for a U.S. IPO since 2021. Shares of the semiconductor connectivity company rose more than 70%, giving the company a market value of almost $9.5 billion and adding momentum to the AI stock frenzy. The listing is the fourth largest in the U.S. this year, according to data compiled by Bloomberg. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, relaxing the rules for EVs.
When you look at this, the consumer is pushing in the direction of hybrid. As we look at this in the near term, we're going to see hybrids continue to gain in popularity. EVs are stagnating. So I think we're going to see, a market that gets, heads towards hybrids.
The latest on policy down in the nation's capital. Up next from New York City. Good morning. The rally continues. If you're just tuning in, up another third of 1% on the S&P 500 following an all-time high at the close yesterday. We called it the everything rally, a rally in the bond market too. We are lower again in yield, down almost 5 basis points. The 10-year 4.2255. Under surveillance this morning, relaxing the rules for EVs.
It's a major part of the economy. In the U.S., it's 4% of GDP. It's a larger portion of your employment base. When you get into the secondary market, it's twice that. So if you were trying to drive and support an economy, this is really where you start. When you look at this, the consumer is pushing in the direction of hybrid. As we look at this in the near term, we're going to see hybrids continue to gain in popularity. EVs are stagnating. So I think we're going to see, a market that gets, heads towards hybrids.
Here's the latest this morning. The Biden administration easing planned regulations on the auto sector, making room for hybrids in the push for more electric vehicles. The new rule also giving automakers more time to comply with stricter emission standards before the year 2032, after warnings from industry and Labour leaders. Craig Trudell of Bloomberg joins us now out of London. Craig, this feels like a win for the traditional automakers who are maybe considering leaning into hybrids a little bit more in the next few years and perhaps over the not too distant future as well.
Yeah, I think it's a sort of bowing to reality on the part of the Biden administration, seeing the challenges that they're having, really sort of getting the electric vehicle sales going. I think, when we look out 8 years from now, it's hard to believe that we'll get to some of these numbers that, are sort of implied by these rules. And yet, if we look back, 8 years ago, I would have called you crazy if you said that, the Model Y was going to be one of the best-selling vehicles in the world. And so this is an industry that has been changing really quickly, much as we have seen this real substantial slowdown lately in terms of momentum for EVs. I do think that we will see both, more of hybridizing what maybe in the past would have been combustion cars, and still, some continued effort to really get the consumer, interested in going fully electric as well.
Craig, there is this question of whether this is signifying some sort of shift in the administration stance, to John's point, not necessarily trying to support electric vehicles per se, but overall targeting emissions with a greater acceptance of whatever means they use to get there. Is that an accurate reflection of how the administration seems to be slightly altering its tone?
Yeah, I think that's right. And I do think that this was a rulemaking process that was, pretty tense, where you had some pushback on the part of several automakers, Toyota and Stellantis, which are big employers in the U.S. You also had real concerns raised on the part of the United Auto Workers Union, and that is a very key constituency for President Biden. He did not want to be, sort of giving fodder for pushback against his re-election prospects. This idea that he wasn't looking out for the interests of the U.S. auto worker. And so, the UAW has a very interesting sort of history of being a group that is very invested in the environmental movement, and yet they are concerned about the threat that this poses to folks who work at engines and transmission, combustion assembly lines across the U.S. And we talk a lot about, the idea that electric vehicles have fewer moving parts, less, things to put together. A huge part of what, is potentially disruptive here is, some of these less paid attention to factories that do, some of the powertrains as opposed to putting the end vehicles together.
You raise an interesting point. How much of the rhetoric, and we're hearing a lot of it around the auto industry right now, how much of it is just purely driven toward the election and will die out, along with all of the proposals, whether it's some of the changes to this administration's approach, or whether it's Trump's talk about maybe 100% tariffs on Chinese-made vehicles coming in from Mexico? Is this just talk to get ahead of the election?
Well, it was really interesting to hear, some of this rhetoric out of Trump, because the numbers that he's thrown around have been sort of all over the place in terms of what exactly he's going to do tariff-wise. But I think, generally we're going to hear more and more of this, rhetoric about the threat that Biden's efforts to electrify the industry poses, because there is, some validity to this idea that this is going to be a disruptive force. And so, even as workers maybe are willing to hear Biden say that he's looking out for them, there is a real concern about, just how much there's a sort of willingness to change, because this is an industry where, a lot of the folks who have worked on these assembly lines and in these factories have done so for decades. And so if you're going to fundamentally change this industry, that's, requiring a leap of faith. And I think you're seeing Trump sort of seize on that willingness to sort of second guess what Biden is talking about. Yeah. And yet this is, something that Biden can point to as a real sort of achievement in terms of, what the IRA has accomplished, how much investment it's attracted.
Craig, I'm thinking of Detroit this morning. So they've got clarity on policy now in Washington. They can really start to plan. Mary Barra, as you know, at General Motors was starting to consider going back to hybrids, something they've been reluctant to do because they really wanted to go all in on EVs. What do you think the next move is from some of these automakers?
I think it's going to be the case that, generally combustion only is just not going to cut it anymore. I think in order to come anywhere close to where these sort of rules are requiring, you need to at least partially electrify virtually everything. And so, whether that means, slowing down some of the, fully electric move, I think we're absolutely seeing that in terms of, getting cold feet about, just how ready the consumer is to go fully electric. That may be the case, but you can offer conventional hybrids that don't even have a plug, and you don't have to worry about sort of bringing the consumer along even to whether or not they install, a plug in their garage. Even just, going in the direction of partially electrifying combustion engines will go a long way to, reducing the emissions of the fleet and, getting the consumer used to this idea that there's also, by the way, reasons that this, can improve the performance of your car. If you get a little bit of extra oomph off the line, that may sort of open the eyes of the consumer of, what, maybe this isn't so bad after all.
I tried to get some detail out of GM. Craig, I struggled too, and I wonder if you know where this is going. How easy is it just to transition on the factory line to start making hybrids?
I think I listened to your interview with Mary Barra a few weeks back, and she was a little bit cagey about this. It is not going to be, snap your fingers and these plants shift over to hybrids. This is going to be something that's going to play out, probably going to take GM a good year or year and a half before we start to see, some of this decision that they've made just in the last few months to really sort of come to fruition, and for us to see this, end product of more hybrids available at your dealership.
It's a notable shift. Craig, appreciate your time. Craig Trudeau there out of London on the latest from the EPA. In many ways, and let's start with the administration, attempting to speak out of both sides of their mouths, I guess, because on the one hand, they want to speak to climate activists. We're going hard. We're going to be tough. On the other hand, they want to give concessions to union workers, auto workers in Detroit to say we're not going as hard. You can do other things as well.
Which means that ultimately, are we looking at a policy that's shifted? Or are we looking at rhetoric that shifted ahead of an election, right? If we hear what Craig is talking about, what a lot of the auto manufacturers are talking about, the fact that these rules were altered based on some of the feedback from the auto manufacturers in the United States, it feels like this is a slight shift. The focus is now more on emissions. It's less on electric vehicle subsidies in the same kind of way. And to me, there will be history books written about whether this sort of indicates the end of an era in a way, and some of the hopes and dreams of that particular state.
Possibly. It's not about what you think, it's not about what I think. Ultimately, and you've said this, and I think you were dead on when you did, this is where the market is. The market has spoken, and they've had to listen. Otherwise, you're going to get automakers in Detroit in a big, big mess. Equity futures right now on the S&P, positive by 1/3 of 1%. Live from New York, this is Bloomberg. What a move yesterday in the equity market. Green light, buy stocks. Chairman Powell. Equity futures now adding some more weight to that rally. Up by another third of 1% on the Nasdaq, up by 0.7. Small caps outperforming yesterday big time. The Russell, biggest day of gains in about a month. Up again this morning by 0.6%. In the bond market, let's turn to fixed income. Starting the week through 470 on a 2-year. Down another 4 basis points now, 455.97. Lisa, that's quite a turnaround over the last 4 days.
If you take a look at Fed funds futures, traders are now pricing in about a 70% chance of a June rate cut. That is up from 57% chance the day before the press conference. This is Jay Powell doing greatest hits of dovish knocks, basically saying, we're going to cut rates. So stop it with thinking that this is somehow going to change the whole picture. The market got the message loud and clear, and it's off to the races.
You know what TK would say? That's a great band name. What was that? Dovish hits after hawkish knocks.
Well, it's a lineup. It's a band lineup, which is essentially what we saw yesterday.
This is a very different Fed chair compared to the one that we heard in August 2022. Completely different.
To me, I was really thinking a lot about this last night with the little capacity that I had left to think. There was this question of, are we looking at a time where you have fiscal stimulus that's coming in with still full force, and then you've got monetary stimulus that on the edges starts to come back to the fore? What happened to the fight between these two? They're in sync, which raises this question. Yeah, it's a green light to stocks. Yeah, it's a green light for risk assets. There's a question of, is there a consequence? Or is this just a golden era of incredible growth and incredible stimulus?
The consequence yesterday was a weaker dollar. There were many other consequences as well. Let's turn to foreign exchange and look at what's happening at the moment. We've got a surprise move from Switzerland. In Zurich, the SNB, Swiss National Bank, cutting interest rates, going against consensus. So what do you have? A weaker Swiss franc. Dollar Swiss, Lisa, out by about 0.7%. Later on this morning, I think about 90 minutes away, we'll hear from the BOE. It's the BOE's turn a little bit later. What interests me about the Bank of England is the vote. There are a couple of members of the MPC putting their hand up and saying, I think we should hike interest rates. I wonder if the recent data just clips the wings of the hawks at the Bank of England.
Everybody wants to cut and everyone's a dove, right? Do we end up with a unanimous vote at least that the goal is down? It isn't necessarily up, because that was sort of one of the tensions at the Bank of England. Swiss National Bank, very different picture than the Bank of England, because they're looking at a different growth backdrop and a different kind of dominance of their currency. They want a weaker currency. For the Bank of England, it's this delicate dance, especially as they try to deal with a deficit and growth that's still sluggish.
SocGen, note just dropped in my inbox, title, Flock of Doves. Flock of Doves, which is kind of what it feels like in the last day or so.
Another band.
I know. Under surveillance this morning, Fed Chair Jay Powell staying on message, fueling a rally in stocks and bonds, insisting that tolerance for inflation has not shifted.
It doesn't mean that. What it means is that we've seen incoming, as I pointed out in my opening remarks, we did mark up our growth forecast, and so have many other forecasters. So the economy is performing well. And the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation. But nonetheless, we continue to make good progress on bringing inflation down.
That came right at the beginning of the news conference, and I think those comments are so important. Going into that press conference, there was a clear and we thought obvious contradiction in the forecast for 2024. And if you go through the summary of economic projections and just look through the median projections, so growth comes up by quite a lot, unemployment comes down, CPI revised higher by just a little bit. And then you're looking at the median dot and you're basically saying, well, the median dot's unchanged, even though growth is going to be stronger and inflation is going to be a little bit higher than they're projecting. So it raised the obvious question for both of us. Are they willing to tolerate higher inflation? What gives? And then you get that response there. And he refers to inflation, and you and I were talking about it as the press conference was ongoing. It was a little bit higher as a separate matter, distinct from what's happening with economic growth. And I think he made that point repeatedly in different ways in the news conference as well. Stronger growth is not something that we're concerned about at the Federal Reserve. And we heard the same message at the end of January. It's on repeat at this meeting too.
And to me, I sort of shrugged it off as sort of, well, maybe he's just trying to hem and haw and get around the fact that it's not some sort of cohesive message from Fed members. It's each one of them coming up with their own guidelines. Rick Reeder, though, of BlackRock, had a really interesting point, which is essentially that inflation has not been a function of Fed policy on the way up or on the way down, and that essentially this is completely independent, and that some of the interest rate sensitive areas of the market aren't really fueling a lot of the inflation. And so the Fed's kind of impotent. And what they're trying to do is gauge how to not become part of a problem as some of these other areas right size, which really raises a question, has the Fed lost control over the inflation narrative entirely, which is the reason why maybe stock markets have kind of moved on.
Did they ever have control? So
Correct.
Rick's colleague, Jeff Rosenberg, joined the programme. If you missed Jeff, it was absolutely fantastic. When you asked the Federal Reserve and this chairman, can you give us evidence of how we are sufficiently restrictive? He'll point to the labour market. You ask economists about the labour market and the loosening, the easing that we've seen there, the cooling. They'll point to the supply side of the labour market. They won't even mention what's happening with demand because it's not about interest rates. It's about immigration, which is what we've heard repeatedly from economists on Wall Street.
Which is the reason why it's been so difficult to get the cycle right. And it's so difficult to come up with something cohesive and understandable, frankly, to say. I mean, it's mind-spinning, right? This from Rick Reeder. We find ourselves with a policy interest rate structure that in some ways is inefficient, slowing some segments of the economy quite a bit with high rates while appearing quite ineffective in reducing activity or price gains in many of the services segments of the economy. This is essentially where we're stuck. If the Fed is ineffective, essentially, are they basically saying we don't want to slow things materially on the other side? And then what's going to offset the other part? Is it going to be immigration? Is it going to be supply side responses? It's saying, over to you, government.
Overwhelmingly dovish, I think, without a doubt. I finished the news conference yesterday, and as we wrapped it up, I think we both said the equity market bulls would just like to hear that news conference on and on and on. And if you're tuning in this morning, maybe you just want us to replay the whole thing. Instead of doing this programme, we'll just replay the news conference for 60 minutes back to back for the next 3 hours. And equities can keep climbing higher. We're not going to do that. We're going to talk about another name. We're going to talk about Apple. The Department of Justice is set to sue Apple as soon as today for alleged antitrust violations. Bloomberg reporting the DOJ will accuse the world's second most valuable tech company of blocking rivals from accessing hardware and software features on the iPhone. This would be in addition to the Biden administration's other antitrust suits against big tech. The DOJ has a lawsuit against Alphabet accusing Google of monopolization, and the FTC is pursuing action against Meta and Amazon as well. They are not in a good spot, Apple, negative 7% year to date.
Which is, again, kind of interesting given the fact that this government has been quite keen on the antitrust efforts. I will just note, though, people looking for some sort of different antitrust approach with a change in administration. This DOJ case was opened in 2019 under the former President Trump. We're looking at either candidate continuing with this antitrust type of action, which is compelling to me, given that a lot of people are saying it's sort of polarizing who to win.
It's such a good point, just how much distance is there between these two leaders at the moment going into this election later this year. Let's turn to foreign policy. US National Security Advisor Jake Sullivan making a surprise trip to Ukraine, looking to assure allies aid will be delivered for the country's defense against Russia. Sullivan saying, quote, "We will get a strong bipartisan vote in the House for an assistance package to Ukraine. I don't think we need to speak today about a plan B." But Speaker Johnson has refused to act on a $95 billion aid package passed by the Senate, which includes support for Ukraine, Israel and Taiwan. Leslie Vinjamuri of Chatham House joins us now for more, just as leaders start to regroup in Europe and talk about what to do next. Leslie, let's get to that. And can you explain to us, just frame, how much distance is there between Macron and everybody else?
Well, I think there is a divide, and Macron's really pushing forward, setting France out as a leader, saying that the possibility of Western troops in Ukraine is not unthinkable, and really at this meeting, doubling down on how does Europe work together to increase basically it's rearmament, and how does it, finance that? That I think is the big question here. But I do think, as you've suggested, France is and certainly distinct in its views from Germany, from the UK, and even from the US. But there are others in Europe, Poland, and those Baltic states closer to Russia, who share this view. And interestingly, some leading commentators, Fareed Zakaria, came out recently with an op-ed saying a similar, that the worst thing would be for Putin to win, and Western troops of some form on the ground should not be unthinkable. So there is momentum. And the backdrop to all of this is, of course, that ongoing fear that America will not deliver the amount of money that's necessary to really continue to sustain that support for Ukraine, even under Biden's leadership, and something that could, of course, change quite dramatically were Trump to be elected. I do think, and what we're hearing now is that supplemental bill that the Speaker of the House will allow that to go forward, and there will be funding. But that is not reassurance for very long. That it won't be enough, and Europe knows that it needs to step up.
And just to sort of sit on that existential concept that the Euro region is facing, how much discussion is there of the ways to finance this, akin to what Emmanuel Macron was talking about with war bonds and things of this nature? Because this is really the key struggle. How do you pay for supporting Ukraine by Europe while also investing in some of the military strength, the heft, that the former President Trump is asking for, and frankly, they feel like they'll need, especially without necessarily being able to rely on the U.S.?
Yeah, I think there are two things here. One is there's an urgent question about how Europe contributes to defending Ukraine and getting those armaments there and how they pay for them. And then there is the longer term question, which speaks to the pressure from the former president, but quite frankly, from multiple U.S. presidents, and one that will be sustained regardless of who's elected. But on the question of bonds, that will be very controversial. It strikes me that it's unlikely to move forward quickly. There is the broader question of using Russia's central bank frozen assets. That, I think, is getting a lot of traction. But this question of financing the support for armaments is critical at a time when European economies are, of course, not strong on the whole. So this meeting today is very important. And once again, Macron is an outlier and really setting forth a bold vision that many people are concerned about.
Leslie, can we talk about those frozen assets? They've been on the table for quite a while. I'm just wondering, what is holding that up? Is there a specific obstacle, a legal issue, a specific country, perhaps in Europe, that's doing so? Where is the holdup coming from?
I think that many people see this as breaking a fundamental norm. There's been, a shift in opinion. The debate has been going on for a very long time. The opinion has shifted, I think, in favor. And there is a question of exactly what are those assets used to finance, and that's a line that many people draw in different places. Some don't think it should be used to finance the direct purchase of armaments. Some have wanted to focus it primarily on the day after on Ukrainian reconstruction. But of course, that day after, you only get there by changing the balance of power on the ground and getting to some sort of peace. And so there is, once again, a question of urgency. But there is a legal and a normative position that divides many people across Europe and in the United States.
Yeah, in a big way. Leslie, thank you. Leslie Vinje-Murray there of Chatham House. It's difficult. A lot of this money, a lot of those assets are in some European countries. I think one is Belgium and the other is France. And what you have, Lisa, is how do you confiscate assets from a country you're not in direct conflict with? And that's the conversation that we've been having now for quite a while.
And how do you then move forward with having confidence put out there in the marketplace that you're a sort of loyal steward of the money that you've been given to hold custody of? It's a difficult moment. And this is something that we keep talking about, which is how do countries lose the ability to act with impunity, right? Like, how long can their sort of historical power get them through an era where they're changing the rules in real time? What
kind of precedent are you about to set? Equity futures right now on the S&P 500, positive by 0.3%. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackes. Hey, Yahara.
Hi, John. The U.S. is pushing for an immediate ceasefire in Gaza tied to the release of hostages held by Hamas. Speaking in Saudi Arabia, Secretary of State Antony Blinken says the U.S. is circulating a draft resolution at the UN Security Council calling for a temporary pause in the war. This marking a change. Until now, the U.S. had used its veto power at the UN to block calls for a ceasefire. This is Blinken's sixth trip to the Middle East since the Israel-Hamas war broke out on October 7th. Reddit will begin trading today. The social media platform priced its IPO at the top of its expected range at $34 a share. The offering values the company at almost $6.5 billion. Shares will trade under the ticker RDDT on the New York Stock Exchange. Bloomberg Technology will have an interview with Reddit COO Jen Wong live at 11:45 Eastern. The LA Dodgers firing the interpreter for superstar player Shohei Ohtani. ESPN reporting the player's longtime friend and interpreter Ippei Mizuhara racked up debts to a Southern California bookmaking operation, which is under federal scrutiny. Questions were raised after at least $4.5 million in wire transfers were sent from the baseball player's bank account to a bookmaker. Ohtani signed a record 10-year, $700 million contract with the team last year. That's your Bloomberg Brief. John?
Yahara, thank you. That story's insane. That's nuts.
Especially because he allowed, a $4.5 million transfer from his funds? And you know that the Dodgers are going to say, like, oh, it doesn't matter, just get out.
You know you've got a lot of money when like $4.5 million is kind of a rounding error, right?
I can relate.
It's like small change. Oh, totally. Of course. Up next on this program, the Fed staying on message.
Powell's basic message is that the underlying story hasn't changed. We didn't completely buy into how good the inflation numbers were in the second half of next year. We're not completely put off by the bad inflation readings in January and February.
That conversation coming up next, live from New York City. This is Bloomberg. Record high at the close yesterday, adding some weight to it this morning. Good morning to you all and welcome to the programme. Up 1/3% on the S&P 500. Yields a little bit lower again, down another 4 basis points, 423.34 on a 10-year. Euro not doing much, 109.19. Under surveillance this morning, the Fed staying on message.
Powell's basic message is that the underlying story hasn't changed. We didn't completely buy into how good the inflation numbers were in the second half of next year. We're not completely put off by the bad inflation readings in January and February. We still think monetary policy is tight. We still think we're going to get more confident about getting inflation down to 2%. And so we still think we're going to cut rates this year. Timing is uncertain.
Here's the latest this morning. The post-Fed rally continues after the central bank reiterated its outlook for 3 rate cuts this year. Ian Stealey of JP Morgan Asset Management writing, quote, "This is a Fed that wants to cut rates. There is still time before the June meeting for the data to fall into place, although the narrative has definitely been challenged." Ian Stealey with us here in New York. Ian, good morning to you.
Good morning.
The chairman says he's committed to getting inflation back down to 2%. Do those projections look like they're committed to getting inflation back down to 2%?
I think he's more committed to keeping the US economy moving forward. I think he's indicated that probably happy to tolerate a little bit higher inflation and making sure that we do keep this soft landing in place. I think that seems to be his main goal. I don't think I've heard anything particularly different from what he said in December.
If that's the big takeaway for you, despite the fact that data has changed somewhat, what does that tell you that you should do in markets right now?
It tells me the everything rally is likely to continue for a little bit longer. It tells me that people want to be invested. It tells me that stock markets are going to do what they've been doing over the last 24 hours. And it tells me that ultimately investing in the fixed income market also makes sense.
So basically, Powell came up there and said, here's your cake. Here's a fork. You can eat it as well. And there's a question of how long can this go on before there is some consequence on the other side, maybe a stomach ache, indigestion, weight gain issues, whatever the case may be. Because at a certain point, don't you have to think about, does this allow inflation to run hotter and then maybe make longer-term bond, the proposition for longer-term bonds less attractive?
I think what we heard is that they do believe they've got inflation coming down under control. Maybe the last couple of months have been a bit of a blip. They've said they're willing to look through that and see that the downward trajectory is still there. I think they genuinely believe they're in very restrictive territory, and they don't think they're taking themselves into easy territory. They think they're just effectively taking the foot off the accelerator of tightening to allow the economy to continue to grow. I think the first few rate cuts that we see are going to be driven by inflation. If we want to see a really serious rate cutting cycle that we've seen through other cycles, it's then going to be a deterioration in growth, and we're not seeing that at the moment. So I think that's what we're hearing is we're going to have a few rate cuts unless things get a lot worse.
Do markets agree that they're in very restrictive territory?
When you look at financial conditions, no. But also those financial conditions are expecting the Fed to be easing off a bit. So we have to remember that there is still, a lot of cuts priced into the system, which is what the market likes at the moment.
At what point does it stop? Or do you just sort of pile in? I mean, why not, and I joked about this, lever up and just pile into risk, because basically you're getting a green light not only from the Fed, but also from fiscal governments that are continuing to spend.
I do still think we've had a lot of tightening, and I don't think the lags have been as quick as maybe we've had through previous cycles. I still think there are concerns that those lags are going to come down the road at some point. So I don't think you want to be indiscriminate. I do still think you want to roll up your sleeves and make sure you're in the right corporations. But it does feel like the central banks are willing to just continue this rally for the time being.
Are we pretending they have control over something they don't have control over? Is that just one big game that we're all playing in the media and financial markets? The Federal Reserve says we're sufficiently restrictive, and we're like, yeah, they are. Look at the labour market. Then when we look at the labour market and you speak to economists as to what's actually happening in the labour market, they point to the supply side as the reason to why things have eased, cooled down a little bit, not the demand side. What do you think the Fed actually has control over when we sit here and, I'm going to say, pretend we are sufficiently restrictive? What do you think they have control over?
I think, no, so definitely supply side has driven growth. I think that's why inflation is coming down. When we look at the employment picture, it went from a very, very hot period. It is slowing. It is cooling down. We're seeing a slowing in wage growth. We're seeing a pickup in quits. Sorry, a reduction in quits. We're seeing a reduction in openings. Things are heading in that direction. They're just heading slowly. And I think the central banks are looking at it. They're looking at what growth is happening to growth. And they're thinking, we can keep this going. We can maintain this if we're sort of cute around how we deal with this, and some rate cuts will help that.
So June is the call for you. Yeah. If the data falls into place, can you explain to us what the data falling into place actually looks like? What is that? Is it 2.5% PCE? I don't even know anymore. What is it?
I think you've got to start seeing 0.2s and 0.3s on a monthly basis on the core PCE. If we start seeing a whole list of 0.4s, I think that is going to call that into question. But I also think we're in a mindset where the central banks, they do, like Jay Powell, he wants to ease policy. He seems very determined.
You're not the
that
first
is the
to
right
say
direction.
it. Steve Rashuda, Mizuho, said exactly the same thing. You're saying the same thing as well. This is a chairman that wants to cut interest rates. So if I'm looking across the curve right now, listening to everything you've said, I can see why maybe you want to buy the front end of treasuries. Big rally, looking for rate cuts. Further down the curve, I'm wondering if they're willing to tolerate higher inflation, just how things are going to develop at the longer end of the curve. What happens there?
I think you see a little bit of what we've seen over the last 24 hours. You do see the curve steepen up a bit. You do see the front end. Maybe it's the 5-year part of the curve. Maybe it's the intermediate bonds that do really well. I think that's what happens. We've obviously still got an inverted yield curve. We know that typically isn't normal, and we should reverse that at some point. So for me, I don't think you're necessarily going to see a big sell-off in the back end. Given, I do think there's a huge demand for bonds, and I think bonds look attractive in real terms. But it's that front end that obviously can do a lot of heavy lifting. But again, this is more of, in my mind, a carry environment, because I don't think we're going to go back to where we were at the very beginning of the year. I don't think we're going to see 7 cuts unless we start to see deterioration in data. And when you look at the dots, obviously the median stayed the same, but the mean just moves a little bit higher. So there are the Uber doves out there who were calling for 4 or more cuts this year. They seem to be taking a cue from the data and sort of coalescing around the central of 3 cuts.
To John's point earlier, how much is this part of the bid behind gold? The idea that is sort of more of a safe haven at this point than longer term bonds when you're not sure about what's going to bring inflation back down to 2%. And people are looking for some sort of ballast at a time where inflation is still a risk.
Yeah, I think there's a few reasons why gold's doing well. Obviously, that is part of it. People are concerned that actually inflation isn't coming down. You want to have that. I think there's people that are saying, well, actually monetary policy is going to be easing. You want to go into real assets. What I don't think it's showing you is that people are particularly concerned around economies. Often gold has been seen as that safe haven asset. But when you look at as you pointed out, you look at the rest of the financial conditions, you look at stock markets, you look at credit spreads, I don't think gold's really showing you that. I think it's more the inflation and maybe more the real asset argument.
Bank of England decision in about an hour or so. I'm not sure what signal I should take from the fact that you're here and not there. Is that something I should pay attention to in 60 minutes?
I think what the most interesting thing for me will be the dissenters.
Yeah.
And whether we get some of those dissenters moved back down. If we get both dissenters saying we should stay on hold, I actually would say the market will take that as a dovish signal. We get the expectations of wage data at the same time. Is that coming down? The movement in the UK has obviously been quite supportive this year. Maybe different to what we're seeing over here, and it'll be interesting to see how the Bank of England are reading that.
I'm going to do it, Tom. I appreciate the dissent. That's what TK would say, and I agree with TK when he talks about this. I appreciate the dissent at the Bank of England.
I appreciate that Ian Steely had a very constructive way of answering the fact that you said, what signal should we take that you're here and not there? But I'll let that go.
Second tier central bank.
That's what
Some people have said.
I'm not going to say that.
Some
I'm going to
people
defend
have
the Bank
said.
of England.
Ian, this was great. It's good to see you. Thank you,
very
sir.
much.
Ian Steely of JP Morgan Asset Management. Coming up next on this programme, on the second hour of Bloomberg Surveillance, Richard Bernstein of Richard Bernstein Advisors, Jennifer Flidden of Invesco, Sebastian Page of T. Rowe Price, and Callum Pickering of Berenberg. All of that still to come, live from New York City. Equities, all-time highs and some. This is Bloomberg.
our policy rate is likely at its peak for this tightening cycle. It will likely be appropriate to begin dialing back policy restraint at some point this year.
I think this is a signal, and the market is taking it as that they will tolerate slightly higher inflation for longer.
So yes, they have to tolerate a little higher inflation in the near term, but I don't think they're giving up on that 2% goal.
I think this is a Fed that really wants that soft landing to continue.
So we still think we're going to cut rates this year. Timing's uncertain. And he said over and over again, it depends on the data.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The signal this market took was buy stocks, heck, buy everything, buy bonds, buy gold. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. The second hour begins right now. Your equity market on the S&P 500 positive by 1/3%. We've heard it a few times on this program in the last few weeks. We heard it again in the last 10 minutes. Ian Steely, JP Morgan. This chairman wants to cut rates.
Even if the data isn't cooperating. And that is the caveat that we learned yesterday. And the reason why people are saying, well, it's off to the races. Because if on one hand you're seeing strength, and the other hand you see a Fed that wants to ease monetary conditions, well, what's the holdup?
I always reflect on guest conversations we've had. I want to go all the way back several months. Ben Laidler, eToro. Ben Laidler comes on the program and he goes, Fed puts back. We both start looking at each other like, what's he talking about? The Fed puts back. After what I heard yesterday, the Fed puts back. He said it repeatedly. And he talked about it in January too. We're not scared of stronger growth. That's implicit, basically explicit in both the forecast and the news conference yesterday. And I think they are basically telling you if growth weakens, we're ready to go. We'll cut interest rates, regardless of whether inflation is, because we're revising that higher.
I want to just issue a mea culpa to Ben Laidler, because when he said that, I immediately turned to you and said, what is he smoking? There is no way. This is a totally different regime. Inflation is front and focus. Ben Laidler, you were correct. And I was vastly wrong. And this is sort of where we are. And to me, this has been the big surprise. And that everyone was expecting that all that pain that we heard from Fed Chair Jay Powell was going to come into the market. It never has. And oh yeah, they're done. They've achieved their outlook.
That Volcker impression back in August 2022 in Jackson Hole, that 8-minute address, there's going to be pain. What pain? Here we are a few years later. I remember a number of years ago where the chairman would say the objective was to extend the cycle. That's what I heard yesterday, even though he didn't actually say it. I think that's what he's communicating. The objective here is to extend the cycle. He doesn't want a recession. He doesn't want one.
You touched on this point earlier, and I keep going back to Rick Reeder's note of BlackRock, where he was talking about how a lot of the inflationary pressures are not in the control of this Fed. The Fed is concerned about sentiment and concerned about things getting out of their control at a time where when you take a look at service inflation, insurance, medical costs, education, none of this stems from an interest rate policy. It raises this question, well, then what's going to control those things? Is it really just supply side kinds of responses? And is the Fed basically saying, we're done because all those things are out of our control?
The concerns from holding too long seem to be greater than cutting too soon based on the communication we got in that news conference yesterday. And I think this market hears it loud and clear. Green light in the news conference by stocks. That's exactly what happened yesterday. It's what's happening this morning. We're positive by 1/3% on the S&P 500. We're calling it the everything rally. It's not just stocks. It's bonds too. We're down 4 basis points on a 10-year, 422.94. On a 2-year, down 4 basis points, 456. So Monday, north of 470. At the front end of the curve. Lisa, here we are on Thursday, south of 460. Big turnaround.
And the consensus right now, 70% chance of a Fed rate cut in June because the data will not cooperate enough for them to go ahead. That's basically the consensus right now in markets.
Coming up through the next 60 minutes, we'll try and challenge that consensus with Richard Bernstein of Richard Bernstein Advisors on why he thinks the Fed may go the whole year without cutting. Jennifer Flitton of Invesco as Biden doubles down on America First, and Callum Pickering of Berenberg ahead of the Bank of England rate decision in about an hour's time. We begin with our top story. Stocks posting fresh all-time highs as Chair Powell stays the course, boosting bets the Fed will begin cutting rates in June. Richard Bernstein of Richard Bernstein Advisors not expecting any reductions this year, even suggesting there's a chance of a hike. Richard, I'm pleased to say, is with us around the table. Richard, good morning to you.
Good morning, John.
Let's start with that press conference. What did you make of that just yesterday?
I have the unfortunate view of kind of viewing him as a bartender still pouring drinks. I think we haven't heard last call yet. And as you said, that's causing speculative assets to go up. And that's the natural reaction that should go on when the Fed is going to provide a lot of liquidity in an already liquid environment.
So what's the answer? Keep drinking?
What's that? Keep drinking. I suppose. I guess my confusion is that there's, as you said, everything's going up. It seems to me that we should be seeing the cyclical sort of pro-inflation side doing much better, and I'm not sure that's actually happening. And so I think there's still very much a speculative fervor within the market, whether it's the Magnificent Seven, whether it's cryptocurrencies, anything like that. I think that's kind of the warning sign out there. But the more economically sensitive stuff should be doing well.
Well, you point to some of the more speculative stuff, and then you say Magnificent Seven, Fabulous Five, if you want to take out Apple and Tesla. I am curious, though, about why that is speculative if the earnings are there. And that's basically the justification that everyone who comes on the show gives.
Right. I think it's not that they're bad companies, right? There's always this notion that we have to worry that somehow these are bad companies. They're not bad companies. The question is, are they unique companies? And I don't think they are. Right. In the latest reporting period, we have, just for the S&P 500, 150 companies growing earnings 25% or more. Right. So only 3 of the Magnificent Seven passed that screen. So there's clearly a lot of choice out there. Why would anybody focus on the Magnificent Seven? And history says that when profit cycles trough and you start getting this broadening of the earnings base, that the market starts broadening. And that's kind of happening in fits and starts, but just not happening.
The theory that we hear from a lot of strategists is that if the Fed were to cut rates, that would actually allow the broadening out. It would allow some of the other 495 stocks to really gain some momentum just because those are the most affected by high interest rates. Why do you disagree?
I don't disagree with that. I think where my confusion is more that why would the Fed want to spur a speculative aspect to the stock market and to the financial markets, period, right? Like cryptocurrencies. Because ultimately, bubbles or very speculative periods, if you don't like the word bubbles are inherently inflationary.
Lisa loves the word bubble. Don't worry about that.
Okay, go for it. Okay. And they're inherently inflationary because you misallocate capital within the economy, right? You allocate capital to things you don't need, and you don't allocate capital to things you do need. So ultimately, you spur inflation. And I don't think the Fed has thought that one through.
Where are the signs of euphoria right now? How do you identify that in stocks at the moment?
I think if you look at just stocks for a second,
sure.
If you look at the Magnificent Seven effect in an environment where 150 companies are growing earnings 25% or more, that I would argue that's euphoria. That was the tech bubble, by the way, in 1999-2000. The profit cycle was accelerating in the United States, but nobody cared. Everybody just wanted tech. Today, the profit cycle is accelerating. Nobody cares. They want 7 stocks. So I was in the stock market. I would say that's the place where you see it the most.
When you talk about how they're fueling a bubble or some kind of speculative fervor, there is a question of whether their policy matters at all with respect to inflation, right? This idea that what's spurring the speculative bubble is not Fed policy at all. It's something else, maybe fiscal, and that the Fed is trying to respond to what they can control, commercial real estate, some of these other aspects, which have felt the bite of it.
Yeah, I think the key word in what you said there that I think is most important is the word respond. That a lot of investors believe that the Fed is somehow a leading indicator. The Fed is a lagging indicator, always has been. Maybe not the Volcker Fed, but every Fed has been a lagging indicator. You think about what they look at. They look at inflation and unemployment, 2 lagging indicators, and they respond to lagging indicators. So that's the thing that I think presents the opportunity right now is that you've got leading indicators that are starting to get stronger. You saw building permits the other day, a leading indicator of the economy getting stronger, but the Fed is still reacting to the lagging indicators. I think that presents a tremendous investment opportunity because it says that we're likely to have more growth rather than less when the leading indicators are heating up and the Fed is going to ease. That to me says you're going to see more growth rather than less, and that calls for cyclicals.
This isn't just a tactical call from you. We've been talking for a while about this. This is a long-term call, a change of regime, if you will. Can you just explain that a little bit more?
I think on top of what we're seeing with monetary policy and everything else, you've got the secular backdrop of globalization contracting. And I think that is the long-term story. I know all the excitement about AI and everything else. I think contracting globalization is the real story because the United States is now in the unfortunate position of having a massive trade deficit as globalization contracts. That is a really bad combination. And it means that the United States is going to have to rebuild our own capital stock. You know, people call this reshoring, nearshoring, friendshoring, infrastructure. You know, there's so many words for this, but it's all the same theme that we have to rebuild the United States capital stock. I think that is the most important story out there right now.
So what do you think is going to work this time in this cycle that didn't work last time in a previous decade, pre-pandemic?
I think small cap stocks, in particular, the area that I think that people aren't paying any attention to, which I don't understand at all, is small and mid-cap industrial stocks. Small and mid-cap industrial stocks have outperformed the S&P 500 over the last decade, even though small caps have not. Small and mid-cap industrials have, which I think is the beginning sign of this kind of deglobalization, rebuilding the American capital stock.
Do you push back against people who say that bigger companies are better equipped to actually handle some of the volatility that we're seeing in inflation and just the global backdrop?
I find the love of large companies very interesting. When I started my career, which was too long ago to talk about, now I hate talking about it because it just says I'm old. But when I started, senior analysts followed small companies because in the late 70s, early 80s, there was a massive small cap rally. And small caps were considered sexy. And so senior analysts followed small cap companies. And the big companies that were boring were followed by junior analysts because there was no excitement there. And as you go through the 80s and into the 90s and the investment banking cycle starts picking up, you find that starts switching. And so now you have everybody loving large caps, saying small caps are no place to be. And I think we've gone 180 degrees. I think it's an amazing thing to see when I think the opportunities are so... The way I describe it to people is, are there really only 7 growth stories in the entire world? Are there only 7 growth stories in the entire U.S. economy? Of course not. There has to be a lot more. That's where the opportunity is.
What if there's only 7 growth stories people care about? It doesn't matter how much you talk about it. It doesn't change things. Well, money's gone passive, the way we invest has changed, and the winners just keep on winning. How do you change that?
So, John, that's kind of the argument that people say, will value investing ever come back? Right? And my point is that everything in life is centered around value. Everything we do is centered on value. If I tried to sell you a Volkswagen for a Bentley price, you would not buy it, right? We all understand value, but for some reason, there's periods in the stock market where people say it doesn't matter. I think this presents a tremendous opportunity for value, given that nobody cares about it anymore.
You're going to be sticking with us. We'll continue this conversation. Richard Bernstein there of RB Advisors. Looking at stocks at the moment, equity futures positive by 1/3%. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The Bank of England is expected to keep rates on hold, giving more time for inflationary pressures to cool before cutting rates. Governor Andrew Bailey opened the door for cuts this year at the last meeting, but maintained a vague timeline, with investors betting the first cut will arrive in August. The decision is due at 8 a.m. Eastern. New Zealand's economy unexpectedly contracted in the final quarter of 2023, pushing the country into recession. Economists had been expecting growth of 0.1%, but instead, GDP fell for the second straight quarter. High interest rates have dampened consumer spending and investment, with the Reserve Bank keeping rates on hold since May, and last month signaling it doesn't intend to lower rates until 2025 amid record immigration and stubborn inflation. Korean Airlines signing a $14 billion deal with Airbus to buy 33 wide-body jets as it looks to streamline its fleet ahead of a merger with Asiana Airlines, South Korea's biggest carrier, preferring the Airbus model to that of rival Boeing, which had typically been the carrier's top aircraft supplier. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, Biden doubling down on America First.
I want to build a future in America. My predecessor could let the future be built in China and other countries, not America.
That conversation up next, live from New York this morning. Good morning. Stocks on the S&P rallying once again this morning. Good morning to you all and welcome to the show. Equity futures up by 0.4% on the S&P. Under surveillance this morning, Biden doubling down on America First.
We will enable advanced semiconductor manufacturing to make a comeback here in America after 40 years. Unlike my predecessor, I was determined to turn things around, to invest in America, in all Americans. And that's what we've been doing. I want to build a future in America. My predecessor could let the future be built in China and other countries, not America.
It's the latest this morning. President Biden visiting an Intel campus in the swing state of Arizona after awarding the chipmaker $20 billion in investments to build out the nation's domestic semiconductor production. Jennifer Flitton, head of US Government Affairs at Invesco, joins us now for more. Jennifer, I was listening to those comments and I was reading the transcript and I just thought, if you changed President Biden and put in President Trump, don't they just sound like each other? Isn't that the same language?
Yeah, we have sort of come full circle. I think this was a very bipartisan bill, right? The CHIPS Act that was passed in August of 2022. And we saw a lot of support on both sides for this movement to bring advanced manufacturing of semiconductors back to the United States. And this wasn't just spurred from a need for global competition, but also we saw the chip shortage from the pandemic. And that was very real, right? Because we have chips in everything from refrigerators to cars. And we saw the constituents of these senators and these congressmen across the nation being affected by that. So that's a reason why, that's the main reason why this was such a bipartisan initiative.
The president was in Arizona at that campus of Intel's. I just wonder how quickly we'll start to see results from these kind of handouts for state money, federal money to companies like Intel. How quickly do you see the benefits from that?
Well, we've already seen some money being given to Intel. They've already announced, even prior, I think, to the CHIPS bill being passed, that they would be creating a facility in Ohio, another important state this election year. But we will be seeing even more grants and loans coming out of the Commerce Department in the next several weeks. So I think this will have an impact in the minds of those communities who are going to be affected and are going to start to see some of those jobs come in. But this takes a long time to create. These manufacturing facilities could take a year, 2 years, and not only that, but you need that workforce. And there's also money in this bill, grants to develop some of that workforce and that education where these facilities are going to be located.
What's the time frame for this bill and the money in it being doled out? And I ask this because people talk about fiscal stimulus running out. Well, is it, or is it kind of ongoing for the next few years?
Right. There was $50 billion included in this bill, and that's going to take a long time to get out. And we even saw, this is a little late. I mean, we passed it in August 2022, and we're now really starting to get that money out the door. And it is going to take even longer for these facilities to be built and start running. But it was already in the hearings leading up to the markup of the bill out of both houses, it was already sort of being told that this would probably be an 8 to 10 year project.
Which raises the question, Jennifer, of what's behind it, right? I mean, we already heard from Pat Gelsinger that he needs more in order to truly compete with some of the semiconductor giants in the world. Is there room to have additional spending on this front, given some of the concerns about deficit, given some of the increases that we've seen in benchmark rates?
Well, I mean, this money has already been allocated. I think the question really will be the next allocation, right? I mean, the Commerce Secretary Raimondo has already sort of signaled that, telegraphing to Congress, will likely need more investment here. But it's not so much the money, it is the dedication from the U.S. government to these companies to show them that we are with you, we are supportive of you, because it's going to take some regulatory initiatives to also ease some of the environmental issues to even build these facilities. There's a lot that goes into this behind the scenes, some of the red tape, and it's important to show that sign of solidarity.
Jennifer, just a final question from me. The policy looks similar. The language sounds the same. Yeah. Who's connecting with voters best? Whose message is more effective, even though those messages are quite similar?
Right. I think there's a populism streak running through American politics right now, and both sides are really trying to latch on to it. I think that as it relates to infrastructure, right, you had the previous administration talking about infrastructure through his entire first term. It finally got done in the Biden administration first term. But those were talks in Congress that were happening for a very long time. I mean, every week it felt like it was infrastructure week. So some of these issues are just by nature bipartisan. And I think we're going to see that sort of push-pull and some of that populism sort of streak running through this election this year.
I think that's actually because it was basically every week was infrastructure week. Do you remember that?
I do remember
Felt that way because it was.
Yeah, well, we were not exactly. We mentioned that frequently.
Jennifer, thank you. Jennifer Flitton there of Invesco. That language, Lisa. I want to build a future in America. My predecessor is going to let the future be built in China and other countries. That could be in a Trump speech. Biden's trying to out-Trump Trump himself going into November.
Which is the reason why the big takeaway for a lot of people is look at what both of them are going to do, which is keep the spigots on. And that, to me, is a huge takeaway at a time where this money is having, real impact in specific states and also for companies.
We've got Richard Bernstein with us. Here's a quote from you, Richard. I want to share it with our audience. Politicians, CEOs, investors understand the US's national security risk of being dependent on the rest of the world for semiconductors, but they don't seem to understand the US's national security risk of being dependent on the rest of the world for virtually everything. How big a change are you expected to see?
John, this is not a change that's going to occur before the next commercial break. I can tell you that. It's going to be something that's really a 5, 10, 15, 20-year story. That exactly what you've all been talking about here is kind of the rebuilding of the American capital stock, that we have become dependent on the rest of the world. That was globalization. And that's fine. As long as globalization was expanding, it didn't matter that we had a trade deficit. Now globalization is contracting. It sets up the United States in a very precarious position, the U.S. economy in a very precarious position, if not the overall country. And I think, we have to come to the realization that we are last among major economies in infrastructure spending still. Despite everything we're talking about, we're last among major economies in infrastructure spending. We are last among major economies in shipbuilding capacity and things like that. These are real issues as globalization contracts, and whether it's Trump or Biden, to me, I think either way, that theme of rebuilding the American capital stock is going to be the central theme of investing for the next 5, 10, 15, 20 years.
Which area looks most rife for opportunity for you as an investor based on that, given the fact that we've seen some stops and starts, right? We talk about electric vehicles. We've talked about the idea that central planning doesn't always work that well.
Right. So, Lisa, let me here's the way I would think about it. I think everybody knows that California has that proposition or law, whatever it is, that by 2030, 2035, all vehicles sold in the state of California have to be electric vehicles. Okay, we could argue, is that good or bad public policy? But the reality is the California electric grid can't support that. Right? So is it a better investment theme to go and invest in electric vehicle companies, or is it a better investment theme to invest in the industrial companies that are going to build out California's electric grid? At our firm, we're betting on the industrial companies that are going to build out the electric grid, because it's the infrastructure that you need to even think about electric vehicles. If you don't have that infrastructure, who cares about electric vehicles?
Someone's got to pay for that. Who's going to pay for that? I'm thinking about the fixed income side of things now. Right. Who's going to pay for that?
That's an interesting question, because now you get into the whole point about we are so debt laden. How do you pay for all of this? I think the necessary evil, and this will of course get people riled up, you're going to have to raise taxes. You're going to have to. You're going to have to raise taxes. You're going to have to redirect spending. It's going to be a whole different story for both parties, right? I think the Democrats are going to have to give up on the notion of let's spend for the 2-year election cycle. I think the Republicans are going to have to give up on the Laffer curve in an open economy, because the Laffer curve has proved not to work in an open economy. Our tax cuts have stimulated other countries, not the domestic United States. Is like, well, think of Apple. Where does Apple gets corporate tax cuts and they build plants in China? That type of thing. I think you're going to have to see a complete reorientation of both parties' economic policies.
It's a lot of work, Richard.
That's what I'm saying, 20 years.
And I've only got 60 seconds left. Yeah. Richard Bernstein of Richard Bernstein Advisors. Plenty of work, Bramo. How quickly are we going to see those political changes? How quickly is that going to happen?
Well, that's what I'm thinking. Maybe that's what you need to have happen to balance the budget. Will you actually get that to happen, given that every election cycle it's sort of a race to the bottom in terms of who can cut taxes and give out, more incentives to people that their lives are going to be better?
Richard, this was great. Got to do it again soon.
Yeah,
thank you, buddy. Equities right now up a third of 1% on the S&P 500. Coming up next, Sebastian Page of T. Rowe Price on the Momo, the FOMO, and the YOLO. That is not my quote. That is his. He owns it. We're going to be talking about it next. Things are so euphoric this morning. Our next guest, Sebastian Page, believes he can get me to go on the Icon of the Seas, a cruise.
I think he will be able to. Yeah. There's a gym.
Seriously.
There's lots to do.
That's when you know there's been way too much happy talk if I ever agree to that.
Well, hold on a second. Are you thinking about it?
Absolutely
Hold on
not.
a second.
Not
Headline.
Even
Jonathan
for a
Ferro
second.
is actually going to go on the Icon of the Seas.
Not even for a second would
But I think that you just said that you were considering it.
Absolutely not.
I think you said the words, considering
I cannot even come up with a number that would make me want to go on that ship for a week.
We'll work on that one. We'll try to come up with some numbers for you.
They can work on that one. Let's figure it out. Have to be very, very big. Equities right now on the S&P, positive by 1/3%, up by 0.8%. I don't take bribes, just in case you're wondering. In the bond market, 2-year, 10-year, 30-year. You know, people are going to clip that, you know.
Yeah, exactly.
He's willing to take money to go and,
they're going to cut off the first part.
I'll say this,
bribes.
if I ever speak favourably about cruises, you know someone's paid me.
Actually,
okay?
it means that you've had artificial intelligence replace Jonathan Ferro.
Possibly, the robot's here. Down 3 basis points on a 2-year, 456.82. The everything rally continues, down 4 basis points on a 10-year, 423. Want to turn to foreign exchange briefly. Surprise rate cut, if you're just waking up stateside, from the Swiss National Bank, down 25 basis points against consensus, basically fueling a weaker Swiss franc. Dollar Swiss breaking out by 0.7%, Lisa. That's the first one. Bank of England in about 30 minutes.
I like that you say first one, because yes, this is the first rate cut among some of the, what do you call this, the central bank?
Tier 2 central banks.
Tier 2 central banks.
Yeah.
Either way, there's sort of a race to cut at this point. And I think that you do get this sense that it is beneficial to be on the front end of that, at least for the Swiss National Bank, that's concerned about currency that was too strong for them.
I call them 2-tier central banks or tier 2 central banks, but you can still make a very good living. Have you seen what the S&B president earns? Swiss National Bank president. Upwards of $1 million Swiss.
Seriously?
Which compared to what you can earn at the Federal Reserve as a governor, I think the governors get a couple of $100K as a governor. And I know, granted, you can go and earn lots of money in the private sector after doing that service. I always remember, but I've talked about this a few times, so if you've heard this story before, forgive me. But the ECB, different pay structure there as well. You can get more as the national central bank governor of Italy compared to being the ECB president or serving on the executive board.
You spend a lot of time.
The pay there is all very, very weird.
You spend a lot of time thinking about the pay. Are you thinking of that too?
To go and serve as
serve in the
the
central
S&B
bank. You try to
president,
figure out which
put
central
myself
bank
in the running
would
for
be
that.
the best to
What am I doing here in the last couple of minutes? Going on a cruise, getting paid for a review.
100%.
880 Swiss francs, whatever it is.
Yeah.
1,000.
Yeah, you're going to run the Swiss National Bank and go on a cruise.
I don't think anyone wants me running the S&P. Under surveillance this morning, I don't think they want me running anything. Chairman Powell sticking to script. The Fed keeping rates on hold for a 5th straight meeting, staring down a string of hotter than expected inflation prints to maintain their forecast of 3 rate cuts in 2024.
We believe that our policy rate is likely at its peak for this tightening cycle. The economy is performing well, and the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation. But nonetheless, we continue to make good progress on bringing inflation down.
It's that line there, Lisa, that keeps jumping out. Inflation came up as a separate matter, distinct, almost divorced from growth being better than expected. And it's that message we keep hearing from this Fed chairman, who's essentially saying repeatedly, strong growth is not a problem for us. We're okay with that.
Which really speaks to this point that we've been talking about all this morning, which is the inflation that we're seeing even under the purview of the Federal Reserve? Do interest rates even matter for some of the inflationary pressures? And if so, what's their compass for moving away from restrictive rates if it had no effect on bringing inflation down and at this point, isn't necessarily facing off with an economy that's struggling for growth?
So no moves from the Federal Reserve. We've had a move from the S&B, also had a move earlier this week from the BOJ. First interest rate hike in something like 17 years, done in part to avoid the need for aggressive action later. Speaking in Japan's parliament, Governor Ueda warning that waiting to hike would have greatly raised upside inflation risks, saying, quote, the possibility would have strengthened for very rapid and large rate hikes after the end of large-scale monetary easing. We made our decision after weighing those risks. What do you make of that, Bramo? Just some clarity as to why they went this time, right now.
operation try to strengthen the yen a little bit. That's what I view that as. Basically coming out and saying, stop thinking this is the most dovish thing and ever. We want to keep you guessing about whether we're going to hike rates again. And to me, that's how I viewed it, because there was other kind of rhetoric out of, the ether, some unknown sources talking to people about potential rate hikes, further rate hikes from the Bank of Japan. I mean, this is what we expected when we saw the yen weaken to such a great degree.
So that was the objective. If that was the objective, can we sort of judge how successful they've been in the last few days? The last week, for that matter? Would you say that was I know early days, but would you say that is a success?
I would say that the success for them was that Jay Powell was dovish. And that basically gave them a complete out to be able to continue with a very muddied but otherwise dovish message and not see a massive devaluation, more than already what we've seen with respect to the Japanese yen.
Well framed, because the dollar going into that news conference was strong versus G10. G10 just flipped by the end of the day. Let's talk about a single name, Apple, slightly lower this morning, with the Justice Department poised to announce a lawsuit against the tech giant, accusing it of violating antitrust laws by blocking rivals from accessing certain features of its iPhone. It's the latest in a raft of suits against tech companies, with the DOJ already suing Google and the FTC pursuing cases against Meta and Amazon. I just want to talk about Apple. Let's throw up year to date, just where Apple is right now in 2024. Apple, never mind the Mac 7. We talked about the Mag 1, the Fabulous 1, whatever, NVIDIA. Apple is down by 7% year to date. And it's not just this. It's almost nothing to do with this. Where's the growth going to come from in 24? How quickly can they adopt the AI features for the new iPhone this year to really fuel that upgrade cycle?
Well said. This antitrust suit's been going on since 2019. The larger point for Apple is, on every side, they're getting challenged. And right now, what we saw from the recent innovation with respect to partnering with Gemini, with Google, is that they are up against Samsung coming out with a smartphone that uses artificial intelligence come September, and they need to get ahead of that after the failed venture into the car. This, to me, is going to be a fascinating development for one of the world's biggest companies that was one of the drivers of the strength in the equity market for so many years.
Apple just a little bit softer. We're down about 1% in the pre-market. I need to take a deep breath for this. A quote from our next guest, Sebastian Page at T. Rowe Price. Do you have FOMO on Momo because YOLO? What are you doing to me, Seb? The conclusion, don't fear the Momo. I'm not telling you to load up on risk assets with a concentrated position in large cap tech, but I would not hit the panic button. A fully invested and balanced approach with disciplined rebalancing from growth towards value, leading to a tilt towards value, seems warranted. Sebastian, what was that? What was that? Do you want to explain that?
I wrote that just for you, Jonathan.
Thank you, sir.
Because I know you like acronyms. I also, in my update, revealed that I spent last week on a cruise with my family.
We're going to talk about the icon of the seas in just a moment. Last time we spoke, you said you were enthusiastically neutral. Is that still your approach to markets right now?
We're still neutral. The momentum situation is really interesting. We just concluded a study of momentum. And if you naively buy the top performing stocks every month, and you look at the performance of that kind of strategy, it's at an all-time high. So momentum, based on the data I have, which goes back to the 90s, but I've also looked at data going back further, momentum's never worked this well in markets. And this is kind of worrisome. But the conclusion of our analysis is that when momentum spikes like that, it's not necessarily a bad thing for markets for the next 12 months. That's counterintuitive, but that's what we're finding.
So stick with winners is the essential message here, right?
Yes and no. It's not a systemic risk. The winners themselves, when momentum is high, can continue to do well. You know, the big bear markets we had, especially the last three, 2022, 2018, and 2008, occurred when momentum was actually really low going into it, the performance of that naive trend following. So I was surprised by that. And if you look at all the times when momentum was in its top quintile and you look 12 months forward, the average return for stocks systemically is 14%. And the average return for the high momentum stocks is also pretty solid. Now, here's the caveat. There's a fat tail. And this is what happened in 2000. In 2000, momentum was super high, and you had the mother of all momentum crashes, right? So you have to manage the risk. That's why you end up neutral.
Do you have a fear of missing out on momentum because you only live once? I'm just really deeply internalizing this message that's pretty profound. This idea of the fat tail, How do you know when you're getting close? And if you're not getting close, why be neutral? Why not just be aggressively overweight and into the Momo because of FOMO and YOLO?
Love that question. So we looked at all these.
It's your own question.
We looked at all the momentum spikes historically and studied them and looked at what happens after. And there's a huge difference on whether the momentum is driven by momentum in underlying fundamentals or whether it's a quote-unquote junk rally. So if you look at the quality factor and see if it behaves similarly to the momentum factor, then you can be reassured. Don't fear the Momo. This is where we are right now. Fundamentals have had really, really good momentum, sustaining price momentum in some of the large caps. So it's not a junk rally situation. The big momentum blow up of 2000, non-earners were spiking, and quality was actually not in favor. That's the warning sign you want to look for. And by the way, going back to the last 3 bear markets, momentum can actually weaken quite a bit and go to the bottom quintile before a market crash. So warning signs, Lisa, look for when it gets junkier, when fundamentals aren't sustaining it anymore. We're not there yet. And it can actually soften before a market crash, at least historically.
So why wouldn't you say this isn't euphoria? Why wouldn't you say that this isn't a bubble, this isn't speculative, this isn't, excessive Momo and all the other things that you said? But I'm at a certain point, why not say this is the reality? Because it's supported by the fundamentals, which is the case that so many people come on and make.
Yeah, and another way to look at that question is to look at the price earnings ratio of the high momentum stocks, right? The ones that have done well for the last 12 months, and divide that by the price earnings ratio of the market. So now you're looking at the relative valuation of the high momentum basket. That's actually, it's elevated, but it's not crazy high. You can draw the chart, and you're miles and miles and miles away from prior bubbles. Again, fundamental, sustaining the momentum. I think we're maybe a mile from the cliff, not a meter or a foot from the cliff. So there's time to see if this is going to unfold into a market broadening, which I think it will, and continue to be sustained by the underlying fundamentals. That's the key question.
That's really the question I wanted to ask you. What would make you enthusiastically bullish, away from just being enthusiastically neutral? You offered 3 things to focus on coming into this year. It was earnings, consumer, and the blob of money. Where is that now? How are things developing?
The blob of money is still there. Let's start with that one. I watched your show at Bank of America. I thought it was excellent.
Thank you.
And they mentioned, look, they have 37 million consumers, and they look at the checking accounts, and they mentioned 40% higher balances across income quintiles than 2019. So the blob of money is alive and well. Earnings are going up by maybe a double digit or high single digit. And the direction of Fed policy is down. So everything's awesome. Why aren't we not long? Well, yes, valuations are elevated. We've had a massive rally in growth stocks. So what would make us more bullish, Jonathan, because we like to lean against the wind, would be a market pullback. All else being equal, a spike in the VIX. I miss Tom to talk about the VIX. Seeing the VIX at 25, 30, for us would be a moment to get more aggressive, lean into risk assets at cheaper prices.
Just real quick here, does the Fed not matter?
The Fed matters because everyone is obsessed with the Fed. But in terms of inflation, we've had a supply effect that I think has been maybe even more important than the Fed. I think the Fed will also matter if they surprisingly get more hawkish. My view is that there's upside risk to inflation. Our CEO asked me into his office yesterday to talk about my market views. I sent him an email with one chart. I said, I think this is the most important chart in capital markets at the moment. It's a chart of the 1-year break-even inflation implied by the markets. It was 2% in January. It's at 4.1% today.
Just real quick, how much of the blob of money is going to go into cruise line tickets that are, floating cities on the ocean for some days?
This is your turn now for the review.
Okay,
ready?
so here's I'll give you a one-word review. Tolerable.
You tolerated
Screaming
it.
endorsement.
Yes,
Okay.
the family loved it. And we did go on Icon of the Sea. And it's not as crowded as you think, Jonathan.
Because it's so big.
It's so big, and everybody goes to the same place, the pool, and then you have places to go, different restaurants
To hide.
on the ship to hide. You also go on islands, which is kind of fun, right?
Because you get off the boat.
Yeah, I took my son on a 2-hour hike on St. Martin. That was fantastic.
It sounds lovely, the island piece of it. Would you go again?
Not too often.
Okay. I think that's a no. Well, he tolerated it.
Well, it's for the kids. I mean, essentially, that's what it is, right? They go do their thing.
It's like Disneyland.
Exactly. And then you just
tolerate
try
it.
to hide it and feel like you don't have to entertain them too much. I'm just saying, theoretically, if I were in that position.
Oh, you would do the same thing?
Well, I don't know that I would do the same thing, but
Jonathan, the truth is it's a democracy in my family, and I got outvoted 3-1.
There we go.
To go on Icon of the Sea.
That's it. So fantastic to see you, buddy. It's good to see you, sir. Sebastian Page there of T. Rowe Price. That sounds about right. That didn't look like a man that wants to go on Icon of the Seas again anytime soon. No. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hekes. Hey, Yahara.
Hi, John. The Swiss National Bank cut its key interest rate by 25 basis points, acting months ahead of the Fed and ECB. Officials lowering their benchmark rate to 1.5%. Some investors were betting on a cut, but most economists predicted the rate would stay unchanged until at least June. The franc tumbling after the decision, falling 1% against the euro to its weakest level since July 2023. Reddit will make its stock market debut today. The social media platform priced its IPO at $34 a share, the top of its expected range. The offering values the company at almost $6.5 billion. Shares will trade under the ticker RDDT on the New York Stock Exchange. Bloomberg Technology will have an interview with Reddit COO Jen Wang live at 11:45 Eastern. Micron Technology is surging in the pre-market after it gave a surprisingly strong revenue forecast for the current quarter. The strong outlook underscoring soaring demand for the hardware used to power artificial intelligence. The largest maker of computer memory chips in the U.S. says fiscal third quarter revenue will be up to $6.8 billion, topping the $6 billion expected by analysts. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this programme, the Fed's done. The BOE is on deck.
A plan to bring inflation down. That plan is working, but we do need to stick to it and see it right the way through. As inflation gets closer to its target, that opens the door for the Bank of England to consider bringing down interest rates.
That conversation up next, that decision, 15 minutes away. Counting you down to the opening bow, stocks doing okay, up 0.4% on the S&P 500. In the bond market, yields lower by, let's call it 5 basis points now. The everything rally continues for stocks and bonds, down 5 basis points on a 10-year, 422.75. Under surveillance this morning, the Fed is done, the Bank of England on deck.
We are firmly on track to bring inflation down to its target 2%. This is the lowest headline rate for 2.5 years. And what this shows is that the plan to bring inflation down, that plan is working, but we do need to stick to it and see it right the way through. As inflation gets closer to its target, that opens the door for the Bank of England to consider bringing down interest rates.
Here's the latest this morning, just about 10 minutes away from the Bank of England's rate decision. The central bank expected to keep rates on hold as UK inflation falls to the lowest level since 2021. Callum Pickering of Berenberg writing this: there is a chance that policymakers give a nod to current market expectations for a first cut in June, which they can cement in May when they update their economic projections. Callum joins us now for more. Callum, we're all focused on the vote on the MPC. There were 2 policymakers last time around that did this. I want to hike interest rates. Where are those 2 now?
Well, let's see. I think if we were to lose one and one went for a hold and then one stayed for a hike, I think that would be quite a dovish signal. The other thing just to watch out for, we already have one policymaker wanting to cut rates. So if we had 2, that would also be a dovish signal. And with the Bank of England, unlike the Fed and the ECB, dissenting is fairly common, and often the dissents show the direction of future policy changes. And so these are the kind of signals beyond the forward guidance or beyond any adjustments to the near-term economic forecast that the bank may signal. That's where the market should be looking at the vote pattern.
Callum, let's focus on the vote pattern just a little bit more. Of those dissenters, given the data we've had, who goes into that meeting feeling a little bit more empowered?
Well, I think Catherine Mann is probably the most hawkish on the committee, and her argument will be we're not quite at 2% inflation, although we're heading down, and the economy seems to be strengthening at the start of the year, and so monetary policy works with a lag. I think that's going to be the argument there to just stick with the hike. I think we'll probably get holds and cuts from everyone else. I mean, the general view, I think, at the Bank of England is we've probably done a good job. I know markets are a little unhappy. There's some questions around credibility. Last year, we had to go 50 basis points after a couple of inflation surprises. But if you really lean back and you say, well, we had a massive gas shock, we've increased interest rates by more than 500 basis points, and actually not much happened. We had a stagnation. We didn't have any rise in the unemployment rate. Inflation expectations have come down. Business investment is up. Real wages are up. This is pretty much a job well done. So let's just start taking the foot off the brake. And I think the Bank of England, a bit like the Fed yesterday, will be, dare I say, eager to validate market expectations for a cut in June. And so I think we're really just going to be confirming what we already know, which is a central bank thinks it's done its job and is setting markets up for a cut soon.
Callum, how much is the ECB, the Bank of England, actually getting some signal from the Federal Reserve, having a bit of a green light to have a dovish message because the Fed kind of took the pedal off of the accelerator there?
I mean, look, the Fed's the most important central bank in the world by far. I mean, it's the conductor of the global economic orchestra, the market orchestra. What the Fed says matters for everyone. But when it comes to the Bank of England and the ECB for that matter, actually, I think markets put way too much of a focus and emphasis on this idea that it's about follow the Fed. The UK and the US have very different economic dynamics at the moment. But the UK has had 2 years of stagnation. In fact, a small technical recession last year. We had a major supply side shock through gas, which pushed up inflation. The Bank of England has aggressively raised interest rates. And now the economy looks like it's recovering at the start of the year as inflation is coming down. And so the Bank of England will be eager to just help that recovery along by taking its foot off the brake. The Fed is looking at an economy which for 2 years has been growing above its long-run potential, where inflation may be turning sticky at around 2.5%, unlike in the UK, where we're going to be probably below 2% in the next couple of months. And so the Fed's argument is, well, actually, do we need to cut? To what extent, actually, should we be helping along an economy which is showing absolutely no trouble yet whatsoever of growing above its potential? And so when you rationalize the economies in these ways, there's no reason why both central banks will be approaching their relative inflation problems in a similar way. It just happens to be that it will line up that probably in June we get cuts from both central banks.
There's a question, Callum, we've been talking about all morning, which is, does the Fed rate policy, and this question, does the Bank of England policy really affect inflation? Or have a lot of the inflation features been from elsewhere, supply side, demand side, pandemic-related distortions, as well as some others that really are unrelated and unaffected to a large degree by central bank rates?
Well, I would just keep in mind, if we abstracted from the big shocks, so COVID, the gas shock, we would have had central banks just gradually raising interest rates over this period, perhaps not quite to the levels that we've seen, but over that period, just to reflect the fact that we've solved a lot of the problems that caused the global financial crisis. Neutral interest rates have gone up. And so part of what we've seen is just an accelerated process towards normalization. Now, would inflation have come down all the way? I actually don't think it would have. What we would have seen is, as we suffered these supply shocks, as inflation went up, we would have seen a bigger reaction in wages and price setting. The second round effects would have been stronger. And so what central banks have done is they've neutralized interest rates and gone a little bit into tight territory. The effect of that has been to keep inflation expectations more or less under control, so that once the first wave of this inflation supply shock has faded, it did not then turn into a demand side inflationary problem in a major way. Central banks have actually done a fairly good job. We say, well, could we have done without the inflation in the first place? Perhaps, but at what cost? Just how much unemployment would we have had to tolerate in order to prevent what has been the biggest supply shock, at least for the UK, in more than 40 years? I actually think it's a preferential outcome to suffer the inflation and bring it down and keep strong labour markets and keep business investment growing. I think internally the Bank of England will view it exactly the same way. It's just because they have a 2% mandate, they perhaps can't be so explicit.
That's a chapter we're still in the middle of writing. Callum, thank you, sir. Callum Pickering there of Berenberg on the Bank of England decision. Leaks are about 4-5 minutes away.
And really, people are looking for dissent, since that is one of the unique features that we get over at the Bank of England.
And we enjoy that.
We love dissent.
A bit of action. Love that.
We need to dissent more.
Sure. With each other.
Yeah. I don't know. I don't like dissent. I like being in it.
Up next, Gagi Chowdhury of BlackRock, Alex Webb of Bloomberg News, Stephanie Roth of Wolf Research, Brian Weiser of Madison & Wall. With plenty of dissent in the third hour of Bloomberg Surveillance. Up next.
Our policy rate is likely at its peak for this tightening cycle. It will likely be appropriate to begin dialing back policy restraint at some point this year.
I think this is a signal, and the market is taking it as that they will tolerate slightly higher inflation for longer.
So yes, they have to tolerate a little higher inflation in the near term, but I don't think they're giving up on that 2% goal.
I think this is a Fed that really wants that soft landing to continue.
So we still think we're going to cut rates this year. Timing's uncertain. And he said over and over again, it depends on the data.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance. The third hour begins right now, wrapping up a week of central bank decisions. A little bit earlier this morning, the S&P with a surprise interest rate cut, surprising consensus at least, dropping 25 basis points. Over at the Bank of England on Threadneedle Street, that decision just crossing. Rates stay at 525. We were all looking, though, for two dissenters who previously had their hand up and were asking for rate hikes. Bramo, they asked for rate hikes no more.
Exactly. What we saw is Haskell and Mann both dropping their votes for higher interest rates. We were talking about how great it is for the Bank of England that they get dissent. Well, dissent no more, perhaps, at least for the most part. There was 8 that voted to keep the rate unchanged. 1 voted to lower the rate, but otherwise, across the board, nobody voting to increase the rate. This is a Bank of England that is now facing off with cutting rates soon.
All about how this meeting sets up the next meeting. There is a feeling that at the May meeting, when you get new projections, that might be the time that they reduce interest rates. In a similar way, the Federal Reserve, it feels like the June meeting might be the next time we get projections, and that might be the meeting they reduce interest rates. Either way, they're taking their time. They're not rushing into this.
Everything seems to be coalescing around June for different reasons, maybe for the different central banks. When you take a look at some of their projections, they expect inflation to fall below 2% in the second quarter. They say that wage growth has moderated across a number of different measures. So what this is a Bank of England essentially justifying why they would be in an easing posture at some point in the near future.
The pound right now just a little bit weaker. It was going into this decision with negative 0.4% on cable. The pound against the US dollar 127.38. We're picking up where we left things yesterday in the equity market on the S&P 500 this morning. Equities are higher on the S&P throughout today off the back of all-time highs, Bramo, on the S&P 500 that closed yesterday. We had some weight to that. We had some weight to the rally in the bond market as well. We're down another 5-6 basis points on a 10-year, 421.76.
The Fed essentially, and this is what we've been hearing all morning and what we heard yesterday after the Fed conference, is essentially the Fed is prioritizing the extension of a soft landing and the extension of an economic cycle at the expense potentially of being more aggressive in bringing down inflation sooner. So this raises this question, well, are people then worried about inflation picking up over a longer term? That's why we're pointing to gold at record highs. That still is one of the key questions, and I'm actually very curious about the long end of the yield curve and how that responds.
We wanted to know how the economic data would change the conversation on the FOMC. It didn't. They referred to them as bumps in the road. They're looking through hot inflation prints, hotter than expected inflation prints, and thinking still the trend is intact, and by June, maybe we're in a position to reduce interest rates. Ian Stealing, JP Morgan, hour or so ago, this Fed wants to cut interest rates. And I don't think you can draw any other conclusion after listening to Chairman Powell for an hour just yesterday.
They clearly want to. They intend on doing it. This hasn't set them back. Maybe they haven't gained confidence, but it didn't seem like they screamingly lost confidence that they weren't going to cut rates. Really, to me, some of the big longer-term questions remain. Where do they go to? the terminal rate? How far can they cut given some of this strength? Because a lot of people are talking about just simply normalizing now, not easing. And we're going to spend the next couple of months parsing through that. So stay tuned. It's
the
going to be
next
exciting.
60 minutes as well. It's going to be great, OK? Here's the lineup. BlackRock's Gargi Chowdhury on the Fed-fueled market highs. Stephanie Roth of Wolfe Research on why soft landing and no landing scenarios are colliding. And Brian Weiser of Madison & Wall on Reddit's blockbuster IPO. We begin with our top story. Stocks hitting fresh all-time highs following Chair Powell's dovish news conference. The S&P 500 topping 5,200 and small caps delivering the best day of gains in about a month. BlackRock's Gargi Chowdhury saying this. The updated SEP implies the Fed would begin their cutting cycle even if core PCE is significantly above their 2% target, as long as projections are moving towards the 2%. The backdrop of stronger growth, a stronger labour market and a Fed that is willing to start the rate-cutting cycle is extremely positive. Gargi, I'm pleased to say, joins us now for more. Gargi, let's talk about it. And I want to refer to what you told us coming into 2024. It's important to go back. This market was priced for 6 or 7 rate cuts. You were saying that was nonsense. We wouldn't see rate cuts until the second half of 2024. What were you looking at that ultimately has played out in the fashion you expected?
Good morning. It's so great to be here, John and Lisa. So back when we were here in December and we talked about the 5 or 6 rate cuts that were nonsense, don't think that word was used, but certainly we felt that the market had priced in too many rate cuts. The view there was that inflation would remain sticky. And that's exactly what's played out. We've seen services inflation remain very sticky, still above 5%. We've seen shelter inflation coming down, but not quite at where we would have liked it to be. And then yesterday, I must say, it was very interesting to hear Chair Powell sound so confident about the deceleration. To your point earlier, Lisa, he did say he's not gaining greater confidence, but he still seems to be quite sure that this is just a bump along the road. And for the most part, he's focusing on the deceleration that we got in the second half of 2023 and not so much on the acceleration in the first 2 months of the year.
He's not lost confidence, and I think that's probably the headline, particularly after we had upside surprises on inflation prints. What is in the inflation number right now, beneath the surface and all the detail, that he can take confidence from?
So a couple of things that I was looking at yesterday is for us to get to core PCE at 2.6%, which is the revised core PCE. And, we kind of know what this month's data is going to be given the inputs on CPI and PPI. I think the rest of the year, you'd have to be quite sure that you're going to get PCE at 0.16 or 0.17. So I guess that's one thing that they're relying on, that even if shelter inflation on CPI remains strong, that it's PCE, which obviously we know has a lower weight, that saves them a little bit. So I think that's one thing they're looking at. I also think that he focused yesterday a little bit when he was pressed on this question, that non-housing services, they expect that to decelerate. So again, their super core measure, that is still at 0.47. Imagining that they expect that to come down. The one positive thing that I did see in this month's CPI print was, unlike the January print, the February, every single services sector did not reaccelerate. We did see that in the Jan print, which was scary to me. This time around, when you looked at education and healthcare and medical services, all of those did come back to trend. So I think that is a positive sign. And then finally, goods had like that aberration for used cars. I think that's something we can see moderate based on Manheim prices.
So I understand why the front end of the yield curve would rally. Mm-hmm. As John was mentioning this earlier, I have less of a clear sense of why you're seeing such a rally in the 10-year, with yields now at 4.2%, down from a high just earlier this month, a couple of days ago, 4.3. I mean, you've seen this come in around 10 basis points in the past couple of trading sessions. Does this make sense to you if the Fed is basically saying that they're okay with inflation running a little bit hotter for a longer period of time?
Yeah, to your point, definitely agree that the front end makes sense. The rally that we saw made sense. I think on the 10-year, look, it's just range bound, right? We've seen that 431 level a few times. We got there. We're coming back off. I think between now and the next important print, which most likely is going to be the non-farm payroll that we get, I think we trade in a little range bound fashion. Over the longer or the medium period of time, Can we see yield curve steepen from here? Absolutely. I think that belly of the curve, looking at that 3 to 7 year part, maybe even just up until a 5 year part, that's where you want to own fixed income. I don't think you quite need to get to the 10-year point. I think we can certainly see 430, maybe even a little bit higher than that. But for now, I think it's range bound.
Well, this is why I think the gold rally is actually quite interesting. It's sort of, where do you get that ballast if longer term treasuries don't have the same features at a time where the Fed is willing to ease, even though inflation isn't back down to their target? Is there a sense that longer term bonds don't hold the same kind of ballast that they used to, just simply because this is an economy that will tolerate higher inflation?
I think that there is a sense that it's not just the inflation point, but the supply point. There is a sense that when you have this much supply coming to the markets, and you have a yield curve that is still not pricing in enough term premium, there is a sense that you have better ballast in the belly of the curve. So I don't think it's about fixed income losing its ballast. We certainly have ballast here. I think it's in the 2 to 5 year point where you're much better off stepping out of cash or just diversifying away from equities too. So you don't need to step out into 10s, 20s, 30s. Get it in the 5 year, get it in the 7 year, get it in IG credit, about 6%. Get it in BINC, which is sort of getting you that income in fixed income market. So I think that's kind of what investors should be thinking about. And I want to hit your point on gold. It's been interesting to see how equities and gold are making all-time highs. And I place a little bit of that in the inflation fear, but tips haven't done as well. So I think the way to play this might be an allocation into an asset class that actually appreciates with CPI, which of course is inflation-linked bonds.
So just to go through that again, you think the opportunity might be in tips more than what is already rallying, which is stocks and gold?
I think stocks can continue probably to do well. High quality stocks, though, I think we might see a little bit of a small cap rally here, but what's going to work for the medium term is up in quality rally. And I think tips make a lot of sense. Front-end tips, something like STIP, make a lot of sense.
So that's fixed income. You touched on stocks. Let's just finish on equities if we can.
Please.
What is it about small caps that you would like at the moment? Really big outperformance yesterday, continues this morning.
Oh, I was going to say that we don't think that small caps is going to be even though it did well yesterday, for the longer period of time, over the next 3 to 6 months, it's actually large cap and quality that has done well, that has the earnings growth, that's going to continue to do well. I think the small cap is more of a rebound trade that's happening at the back of a dovish Fed, but I doubt how long it can last.
That rebound continues this morning, up by 0.75% on a Russell. Gargi, love it, as always. Gargi Chaudhry there of BlackRock. Just to recap the Bank of England decision that came out just moments ago. Rates are unchanged. We weren't looking for a change. What we were looking for was the vote on the MPC. Were the two hawkish dissenters still hawkish? Were they still dissenting, putting their hand up for interest rate hikes? They're not. They've dropped that. So that's a change on the MPC and just a step towards maybe a reduction in interest rates. Governor Bailey making the point, though, Lisa, we're not yet at the point to cut rates.
But they're making progress toward that point, and you're not necessarily seeing the same kind of dissent, saying things are moving in the right direction. So at a certain point, is this sort of setting up for June to be that blockbuster month? Maybe that was a stale projection, but at the same time, stale looks right at this moment.
Sterling just a little bit weaker. Sterling having a decent year so far year to date in G10 against the US dollar. Some outperformance there, but on the session we're weaker by a third of 1%, 127.39. Let's give an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hakez. Hey, Yahara.
Hi, John. U.S. National Security Advisor Jake Sullivan is in Ukraine, where he's promising that the House will approve $60 billion in stalled aid to the country. Meanwhile, Kyiv woke up this morning to its first large-scale attack from Russia in more than a month. Ukraine says it shot down 31 missiles that Russia fired on the capital today. New Zealand's economy unexpectedly contracted in the final quarter of 2023, pushing the country into recession. GDP falling for the second straight quarter. Economists had been expecting growth of 0.1%. High interest rates have dampened consumer spending and investment, with the Reserve Bank keeping rates on hold since May and last month signaling it doesn't intend to lower rates until 2025, citing record immigration and stubborn core inflation. The LA Dodgers firing the interpreter for superstar player Shohei Ohtani. ESPN reports the player's longtime friend and translator, Ippei Mizuhara, racked up debts to a Southern California bookmaking operation, which is under federal scrutiny. Questions were raised after at least $4.5 million in wire transfers were sent from the baseball player's bank account to a bookmaker. Ohtani signed a record 10-year, $700 million contract with the team last year. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, Biden's antitrust crackdown heating up.
What we are looking at is kind of where, when you are in charge, you want to push your priorities. And so what we've said on antitrust as well is that we've had a seismic shift at a glacial pace.
That conversation up next, live from New York City. This is Bloomberg. If you are just joining us, welcome to the programme. Record highs yesterday, more on the cards this morning. We're up another 0.5% on the S&P 500. Had some outperformance on the Russell yesterday, the small caps pushing higher. Same story again this morning, up by something like 0.75%. In the bond market, calling it the everything rally, stocks and bonds yields lower by 4 basis points, 4.2275. Earlier on this morning, had an SNB decision, Swiss National Bank reducing interest rates by 25 basis points. Just moments ago, we heard from the Bank of England. The Bank of England keeping rates unchanged, but the vote was different. 127.39. Cable negative by 0.4%. There were two hawkish members of the MPC, Lisa, pushing for interest rate hikes. Those two members not pushing for that anymore.
Not that much dissent anymore on the Bank of England, even though he celebrated all the dissent that was supposedly there. Here's really the question for me. What has shifted so materially for all of these central banks that allows them to have confidence that they don't have to go further? Has inflation come down? Are they seeing more signs of weakness? We heard even Chair Powell pointing to the quits rate as signs of weakness in an otherwise incredibly hot market. Or is there something else that's shifting where the emphasis needs to be on growth and away from combating inflation?
The reaction function has shifted. I think not just the economic data, just the way they respond to the incoming information. Just to describe sticky inflation numbers as sort of a bump in the road, but ultimately the destination hasn't changed.
Which really, to me, highlights a couple of key questions. Number one, how much are central banks standing away from trying to put the brakes on the fiscal spending that we see around the world? I mean, it's not just the U.S., it's also in the U.K., it's also in just generally the Euro region.
Sterling right now, 127.40. Under surveillance this morning, Biden's antitrust crackdown heating up.
We have large antitrust activity in this country. We have major technological change, major income inequality. What we are looking at is kind of where, when you are in charge, you want to push your priorities. And so what we've said on antitrust as well is that we've had a seismic shift at a glacial pace.
Is the latest this morning. The Justice Department preparing to sue Apple as early as today for alleged antitrust violations. Bloomberg reporting the DOJ will accuse the tech giant of blocking rivals from accessing iPhone hardware and software features. The case adding to the Biden administration's antitrust crackdown. The DOJ already suing Alphabet and the FTC, pursuing cases against Meta and Amazon. Bloomberg's Alex Webb joins us now to discuss this story. Alex, let's start with Apple. What are we expecting to hear as soon as today?
Well, the key thing actually will be what exactly the DOJ is going to be focusing on. We know broadly what has been looked at a high level. It's stuff like access to mobile payments. You know, when you use contactless payment, it's access to, you know, for example, if you ask your iPhone to play music, it will default to Apple Music, opening that up to companies like Spotify, forcing companies to give a relatively high percentage of their revenue through iPhones to Apple. All of those things are possible. We don't exactly know what is going to be the focus. So that is something that's going to be looked at with a great deal of interest. And then subsequent to that, people will be able to gauge actually what the likelihood is of the DOJ winning this.
Alex, this is the DOJ. This is the US Justice Department. Typically, we'd be talking about the Europeans going after Apple. Is this becoming global, somewhat universal?
It certainly looks that way. You know, a lot of the action has been led by Europe. We then saw a little bit in California in forms of form of the CCPA and then a few other things that have been coming up. There have been a few state efforts around the US. So far, they haven't actually been massively successful. We are also seeing, a push for more regulatory change in the US. When people start to look at TikTok, for instance, they say, well, actually, it should just be a broader regulation of social media companies as a whole. So the US is gathering pace on this front. The charge is very much being led by Europe, but there are learnings being taken from Europe and applied in the States.
Alex, is this regulatory theater, or does this actually have legs in terms of materially shifting Apple's business?
I think the actual direct impact on Apple's business is going to be around the fringes. What you've seen, though, in the past, and this was absolutely the case with Microsoft, is that if you become subject to persistent, recurring targeting from or criticism from antitrust authorities, it changes the culture internally. There becomes a little bit less risk-taking, more second-guessing, or are we going to get into trouble if we do this? Should I send this email because it might come up in discovery later? Like, all these sort of things can sometimes affect the way a business proceeds and the way its appetite for innovation. So that might be the bigger risk than actually any immediate impact on Apple's top or indeed bottom line.
Alex, my head's kind of spinning today for a host of reasons, but one of them is this question around, is the U.S. government trying to support U.S. tech companies or trying to push back against them? And we're looking at Intel building a plant and the idea of investing in some of the technological leaders. And then we talk about antitrust suits and we talk about potentially banning certain deals. Which is it?
Well, I think it's actually good, and it shows that there is an effective balance of power in government, that there isn't sort of one hymn book from which every arm of the sort of judiciary is singing, or the legislature is singing, right? That they are tackling these things based, it seems, on the merits of each individual case. I think it is absolutely true that the US, and particularly Intel, has maybe lost a step when it comes to chips. The bleeding edge chips these days are made in Taiwan and South Korea, fabbed in those countries. Intel, a lot of that is due to missteps, particularly at Intel itself. So giving a little bit of support to bring it forward, if it is going to be helping the US economy, which it should do, you can see the case for that. So unfortunately, I think each case needs to be taken on its own merits.
Tim Cook today is not in Washington, D.C., with legal representation, nervously worried about what the DOJ is going to do. Tim Cook today is in Shanghai, opening a new store. And Alex, that's what's been driving the stock to some extent. The failure to really find significant growth in markets outside of the United States, and the difficulties in China and at home in the US too, to get that big upgrade cycle that we've been looking for. Alex, where are we? Are we on track to put AI tools on a new iPhone this year?
Well, the reporting from our colleague Mark Gurman suggests that there will be AI tools on iPhones perhaps this calendar year. Will they be tools developed by Apple? That looks less likely, or decreasingly likely to be the case. It very much seems as though it could be Google's offering, Gemini, that is powering some of the AI stuff when you interact with Siri, for instance. So Apple clearly is making a defensive move to try and catch up here. I think it does seem as though the stock has suffered from a perceived lack of AI innovation. As ever with Apple, and I know it risks becoming a cliche at this stage, but you should never count them out entirely, because they are often late to the table with a particular innovation, and yet when they do come to the table, they have something quite compelling. So they have come at it from a very slow start. We are very early in this AI race. They have a lot of existing stickiness with their customers, which of course is one of the reasons why the DOJ is coming after them. But that is something that is very hard to unspool just based on AI. They have time to catch up.
Alex, thank you, sir. Alex Webb out of London on the latest on Apple and the DOJ case against them potentially being unveiled today. And ultimately also the difficulties in China. I think that's what stands out for me today. Tim Cook's not in Washington. Tim Cook's in Shanghai, trying to do something about a market that's lagging somewhat.
Did you see the pictures, the images
of
him entering the store and people kind of cheering?
Thunderous applause.
Yeah, exactly, including someone encouraging everybody to do so. To me, this is really interesting, because how do you try to make a pitch in a country that's actively trying to move away from your product because of where you come from? That's a very interesting moment. And it makes me wonder, do they see a business proposition that other people don't continuing in China? Or is this trying to basically kowtow to the powers that be to say, look, we're committed to this because they've got no other choice because so much of their manufacturing is in China?
It's a massive market for them too. Just an absolutely massive market. I think we get earnings from Apple in early May. We need to turn our attention to the economic data that drops in about 5 minutes' time. US jobless claims just around the corner. The estimate is 213. The previous number is 209. As we often say every Thursday morning, if you draw a chart back like 50 years, jobless claims around 200K is exceptionally low. It's very, very low.
That's why Jay Powell had to look to the quits rate yesterday in the JOLTS data that some people say is messy to try to kind of find any weakness whatsoever in the labor market.
How do you demonstrate that we are significantly restrictive? Quits, apparently.
I knew he was going to go there. That's one kind of landing place for a lot of people. Maybe that's true.
Stephanie Roth is going to join us in just a moment of Wolf Research to react to those numbers. Mike McKee will bring you that data from New York City. This is Bloomberg. Equities on the S&P up 0.5% on the Nasdaq, up 1 full percentage point. Drifting higher. This is not a drift. This is an aggressive rally over the last 24 hours. A green light from Chairman Powell to buy stocks and buy bonds apparently as well. Check out the 2-year. We're down another 3 basis points on a 10-year, down 4. 422.94 on a US 10-year. On a 2-year yield, 457.46. Jobless claims about to break. The estimate is 213. Mike McKee is going to give you the number. Mike McKee, you have that number now.
Not a surprise the way things have been going. We fall again. 210,000 is the number for last week. Continuing claims are down, at least compared with the initial report last week. I don't have the revisions yet, but 1,807,000 compared to 1,811,000. The Philadelphia Fed Business Index comes in at 3.2, which is down from 5.2, but better than the negative 2.5 that was expected. Prices paid in the Philly Fed 3.7 versus 16.6. So I assume that the folks at the Federal Reserve will be happy about that and the idea that maybe prices are going down. Here's the revision. So last week was 212, up from 209. So we fall to 210, and continuing claims were 1,803,000. So we rise a little bit to 1,807,000, but really no change in the labor market. So Jay Powell's labor market is still good, and the latest indication we have on any prices is not bad.
So not much news here. So let's go back to yesterday. Let's go back into the news conference. You're there in the room. Chairman Powell's talking about evidence of being sufficiently restrictive, and he points to the labor market. When he did that, what were you thinking?
You know, it's kind of how you look at it is how I was thinking. You can look at it. It's a little hard to argue flat when it's as round as it is. There's still a lot of tightness in the labor market, which he sort of admitted by saying that the JOLTS numbers have come down, not as far as they were pre-pandemic, but they have come down, and the unemployment rate has remained low. So they're still looking at that as okay, which gives them permission to essentially sit with rates higher for longer.
Were you surprised that Jay Powell didn't have a clearer answer to this question of the tension between higher projections for GDP, higher projections for inflation, but the same number of rate cuts this year?
It's difficult for him. It would be difficult for anybody to square that circle. So you kind of knew that he was going to have a hard time doing that. I think what you do is you sort of look under the hood of what happened at the Fed, and it was that everybody basically moved up, but the bottom people moved up into the median. And so at this point, that doesn't change, but the general feeling among the committee is that there is a good chance that they might go to 2, depending on how the numbers shake out. I thought one of the most interesting things yesterday was when Powell told us what the PCE core is going to be. 30 basis points, so 0.3%, which would be a good result for them. It would be down from the 0.4 that we have been seeing. So Fed staff are giving them some hope, I guess, that the inflation problem was just sort of turn of the year.
How unusual is that for him to leak data before it comes out?
Well, it's very unusual. Now, he doesn't have the data itself. He has the Fed's approximation of the data. So he's not really leaking the data, but they've gone through and done the math, and you can do that with CPI and PPI data inputting into PCE, and they're saying this is what we're likely to get. Now, you know what's going to happen next Friday. Nothing, because the markets are closed, but that's the day they release the PCE, and everybody's going to say Jay Powell was right or Jay Powell was wrong. So he's out on a limb there.
We'll do that from home. At least they're not releasing payrolls. Remember that?
Yeah.
It was always Good Friday, payrolls. Your face then. It's not happening.
Because we would get brought in. They'd say, look, all right, it's payrolls, it's a working day. And you know what? I think everybody felt that.
Yeah. Michael, thank you, sir. Mike McKee, great work yesterday, as always. If you're just joining us, jobless claims 210, the estimate 213, previous week a revised 212. If you're also just joining us, we need to talk about what happened yesterday in the projections. This is a median projection, I know, in the summary of economic projections from the Federal Reserve. So I'll talk about where we are now, where their projections are currently in the March SEP, relative to where they were in December. So GDP, 2.1%, previous projection in December, 1.4%. Unemployment, 4%, December projection, 4.1%. PCE, this is core PCE, 2.6%, revised up from 2.4%. And the median dot, and there's some nuances around this, I know, beneath the surface, but surface level, median dot, 4.6%, in line with the previous one, so implying still 3 cuts this year. Stephanie Roth of Wolf Research joins us now for more. Stephanie, we need to begin there. Good morning to you. We need to start with those projections. What jumped off the page for you when you opened that document yesterday?
By far, it was the GDP number. I mean, seeing that jump by 70 basis points in combination with inflation bumping by 20 basis points and the median dot being unchanged. That just tells you that we're seeing a supply side dynamic in terms of GDP that's not going to bring too much inflation. And by the way, the inflation upward revision was kind of just a mark to market, and that's what Powell said yesterday.
So directionally, it feels like a contradiction, but when you go into the details like that, you don't think it is a big contradiction?
Well, I think it tells you something a little bit about the reaction function. It's maybe shifted to some extent in that, well, maybe they can see slightly higher inflation and they'll be okay with it because they see the path coming down, and they're not worried about strong growth anymore. Last year, that was something that they were legitimately concerned about. Strong growth would bring inflation, and now they see strong growth as not necessarily inflationary because that's coming from the supply side of the economy.
So what's inflationary and how much control do they have over it?
Inflationary could still be the labor market. If that labor supply doesn't actually come through, then that's where you could run into some challenges. If you continue to see really strong payrolls growth and the labor supply doesn't come through, then that becomes a challenge. But the trends in terms of immigration is looking a lot stronger. If you look at the recent CBO projections, there could be a lot more labor supply coming from immigration that could really help.
I guess I'm struggling to understand whether the Fed has had any influence over inflation at all. Because essentially, if what we're saying is that it comes from other factors that are unrelated to interest rates, and it doesn't really matter if you move them up or if you move them down, then what are we even talking about with the Fed here? Like, what is their role in bringing down inflation if the inflation that we're looking at is not related to their policy?
I mean, some of it was transitory. We've had this conversation up here before. Is that they just had to, in terms of risk management, they had to raise rates aggressively because in case that wasn't true, they would have had a real problem. That would have been 1970 style inflation. So they would have had a real problem on their hands. So it's hard to disentangle what was transitory and what was driven by Fed policy. It was probably a combination of both, but the transitory factors seemed to be perhaps some of the more important ones here.
This does raise an important question, though. When the chairman is asked and when Fed officials are asked, are we sufficiently restrictive, and they point to the labour market as evidence that they are they right to point to the labour market as evidence that they are sufficiently restrictive?
Well, that's a tough one. I mean, and Powell talked about his models, and it was, a very vague
Sure, but if we can
answer.
sit here and all agree there is a massive supply-side dynamic taking place now that is leading to changes in the labour market, how can we draw a dotted line all the way back to the Federal Reserve based on that?
I mean, I think that's a tough one. It's probably a combination of the labor supply or the labor market just coming back into better balance, partially because companies who have had excess demand for labor kind of satisfied that and productivity picked up. So a lot of it was a little bit of luck and a little bit of some of the hikes doing their job.
Some people were talking about the awkwardness of basically the Fed fighting fiscal stimulus and that was kind of going to be where we were this year. And it seems as though everyone's talking about spending that's still coming back into the market or coming into the market from the federal government, and a Fed that's okay with that and doesn't see that as inflationary and doesn't see the need to really offset that with materially higher rates for longer. Does that ring true to you, that basically they're on the same page with trying to stimulate, not suppress?
I mean, to some extent, and last year was a good indication. We still had a decently strong fiscal impulse, certainly more so than people expected, partially related to employee retention credits and all kinds of funky things happening under the surface that weren't necessarily expected. The chip spending, which the take-up was really quite strong. So yeah, those two are in conflict to some extent, but as long as inflation is coming back down towards 2%, like that's kind of okay.
So how much are you upgrading your growth expectations just generally for the United States if this is basically the reaction function and the reality that we're in?
I mean, we're at 2.4% for this year, and we've been expecting 3 cuts. So for us, we haven't had to change it. That said, from where we were 6 months ago before Powell pivoted, we were looking at a 1.5% GDP growth. So we kind of made that similar type of adjustment in anticipation of the Fed being able to be dovish for longer, partially because our expectation is inflation should come back down towards 2% with growth still being okay.
When the chairman says we're committed to getting inflation back to target, is he less committed now than maybe he was a couple of years ago, back in August 2022?
No, I think he's still just as committed. I think he's just convinced that inflation is on the right path. And to be fair, he talked about the seasonal problems, and I very much agree with that. I mean, if you look back to core PCE inflation in November, it was up 9 basis points. In December, it was 14 basis points. That wasn't the trend either, and he highlighted that, and that's fair.
Mike McKee, is that why you can call this a bump in the road?
Yeah.
The destination's not changed?
This is what they predicted all along. The only question is, are they going to be right about the fact that it was transitory and that things start to fall back down again? There are some categories that are surprising. Used cars surprised this last time. And we have no idea what will happen with energy the way it's been bouncing around. But their view is we're going to get sort of a natural disinflation to continue.
The T word aggravates people.
I didn't use that.
You kind of did. In
I'll
fact,
use
I think
it.
you did.
Transitory, that's what we're talking about.
There are
still
children
think that's
watching.
the core belief of this Federal Reserve? Ultimately, it's just a word that they're scared of using.
Well, they got pilloried for using it when we were just coming out of the pandemic. And they weren't totally wrong. It was a question of timing. What is the definition of transitory? But a lot of things that went up in price because the supply wasn't there now have come down in price because supply chains have normalized.
Stephanie, what's not transitory? What are the aspects you're watching that give you some pause with respect to the steady pace down?
I mean, some of the service sector inflation is still running kind of hot. And I still believe maybe the transitory is not the right word because it's probably a function of the labor market having been strong. It's just a lagged effect of that. So I would say that's not necessarily transitory. It's real inflation that's happening. People are really traveling, and there are some areas within the service sector where you're continuing to see fairly firm inflation prints. But that as the labor market has cooled, that should continue to slow down. But that's something that I'm keeping probably the closest eye on. And people were talking about the super core inflation, and for some reason they've stopped talking about it. But I still think that's important. That's kind of what we're talking about here.
Meanwhile, I keep going back to Rick Rieder's concepts around inflation and how it really isn't driven by Chair Powell. He says, in part, it's driven by Taylor Swift and the fact that we've been able to see some of these potential things. He didn't actually say that, I'm putting words in his mouth, but he did talk about how there are some independent of the Fed kinds of trends, like the Eras Tour or, the Messi
Waiting
mania.
for a message from Rick now just to say, what is Brownlow talking about?
But he just used all of those things. I mean, how much is the discretionary spending of consumers, though, still kind of a concern that they can shell out $10,000 for a ticket?
Yeah, I mean, I think that's the story that we've had over the past couple of years is people have had a lot of discretionary income. Some of that was this excess cash that was saved up from the pandemic, and that's largely worked its way through. Now it's only sitting in the top income earners, and that's they're probably not gonna spend it to that same extent. But now that you're starting to see these things normalize, excess cash has slowed down. Now we're looking at an environment where GDP growth should actually trend something like 2%, which is what the Fed's looking for.
They're going on the Icon of the Seas, apparently.
To listen to the Eras Tour.
I can't believe Sebastian Page went on the Icon of the Seas.
He was sort of proud of it and then very much backed away. That was backpedaling as quickly as he could.
Have you seen this ship, that cruise liner? No. Icon of the Seas, 3 blocks long. You wouldn't
like
touch a cruise, would you?
No.
I saw that face
okay,
then.
But look,
perfect.
How many adults, though, are doing it for themselves versus their kids? I mean, ultimately, if you can get a vacation where you don't have to actually cater to anyone and they can just
I think
entertain
the older
themselves.
cohort love it. Tom's gone on a cruise. That's where TK is.
Oh, yeah, he's on a cruise?
Loving it.
Yeah.
Time of his life. Got in touch with me yesterday.
Okay, yeah.
Absolutely loving it.
Does he like the water slide?
I'm not sure he went on the water slide.
Okay, good. We'll ask him.
I see Bloomberg Surveillance live on the on
Now there's just some things that no one needs to see, Mike. Stephanie, thank you. Thank you very much. Stephanie Roth there, Wolf Research. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The Bank of England keeping rates unchanged, but 2 MPC members have dropped their support for future hikes. Catherine Mann and Jonathan Haskell joined the 8-1 majority to keep rates at 16-year highs. After this morning's decision, Governor Andrew Bailey cautioned the bank was still not at a point to cut rates. Recent data has pointed to easing inflation and weakness in the labor market, and the economy even faced a technical recession in the second half of last year. The Biden administration is announcing another wave of student debt relief. About $6 billion in debt will be canceled across 78,000 Americans working in public service. Teachers, nurses, firefighters, and others who have been paying for 10 years will have the remainder of their federal student debt balances canceled. In total, this White House has forgiven about $144 billion of debt for almost 4 million people. Senate Commerce Chair and Democrat Maria Cantwell saying she may hold a public hearing on TikTok after yesterday's classified briefing with U.S. intelligence officials. Democratic Senator Richard Blumenthal even calling TikTok a, quote, clear and present danger. So far, the Senate has been reluctant to rush a bill to ban or force the sale of the app. This after the measure passed overwhelmingly in the House last week. Parent company ByteDance continues to deny any wrongdoing. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, Reddit's blockbuster IPO.
I think companies are going to be more disciplined about when they tap the public markets. Obviously, they're going to want to be able to articulate a path to profitability. When companies come to the public markets, they're going to be public market ready.
That conversation up next. You're opening about 45 minutes away in New York City. Equity futures on the S&P 500 positive by about 0.5%. Economic data out about 17 minutes ago. Jobless claims came in at 210. The estimate 213. We call that the right kind of downside surprise. The previous week, a revised 212 from 209. Equities near session highs up 0.5%, adding some weight to the rally of yesterday and through the year so far. Year to date, we're up nicely. In the bond market, bonds rallying, yields lower by, let's call it 2 or 3 basis points, 424.32 on a US 10-year. Under surveillance this morning, Reddit's blockbuster IPO.
I think companies are going to be more disciplined about when they tap the public markets. Obviously, they're going to want to be able to articulate a path to profitability. When companies come to the public markets, they're going to be public market ready. They're going to be able to articulate a very clear message to investors, to their shareholders that will enable them to thrive.
It's the latest this morning. Social media platform Reddit making its market debut. The company raising $748 million with shares pricing at 34 at the top end of its targeted range. Brian Weiser of Madison & Wall saying this as a small but still large digital platform, and like others with logged-in users, likely more valuable to marketeers with every passing year. Reddit should continue to take share of the US and global advertising markets. Brian joins us now for more. Brian, can we talk about that? And great to catch up with you, sir. Just how much ad revenue is that business currently taking on? And how much upside potential do you think there is?
Yeah, I mean, it's something like $800 million globally. I mean, it's a decent sized business, still pretty small compared to the other walled gardens. But you have to remember, they've only been a business in a normal sense for about 4 or 5 years. I mean, they tried to make money from advertising 15 or more years ago, and it didn't go very far. But if you think about the current iteration of the business, it's new, it's still growing. They're doing a lot of good work around brand safety. They're certainly building a lot of deep, big brand relationships. So still pretty early days.
Brian, for big ad budgets right now and the people overseeing them, what does a platform like this bring to the table? What audience do they bring to these guys?
Well, the first thing I like to point out is diversification. in the sense that large advertisers certainly do not like to feel like they are locked in or concentrating their spending too much with the biggest platforms, Google, Meta, etc. So I think that's the first thing to think about. Second thing is they're playing up the contextual advertising thing. Contextual meaning, old school advertising, almost like magazines, where you're able to actually reach people based on interest. What a crazy idea. As opposed to a lot of data, meaning cookies or other forms of first-party data where maybe the consumer that's being targeted doesn't even realize they're being targeted for their personal data. So I think a lot of advertisers really like that element of it, and it's actually good in a privacy-compliant way. So there's a lot of positives in that sense.
The advertisers like it. The ones who don't like it, the Redditeers, right? A lot of people are protesting some of the advertising that's inevitably going to come down the pike, and they resent the IPO for commercializing sort of the bastion of just blunt conversation. How much is that going to matter to the actual business proposition?
I doubt it will matter much. I mean, as long as the users aren't actually turned off in a meaningful way. I say this as a former college radio person where we didn't believe in advertising at all. So I'm mindful of those. Yeah, I'm mindful of those preferences that a lot of people have. But no, I think as long as it's not overly intrusive, I mean, the whole idea of an ad-to-edit ratio is always important. If it's too overwhelming, you do turn users off. But if they're doing something unique that you can't get anywhere else, and there really isn't anything else quite like Reddit. So I think that most people will probably continue using it.
Is there anything else that you see out there that potentially looks like either a candidate for IPO or looks more attractive based on the alternative ways that advertisers are looking for ways for their content to reach eyeballs?
Yeah, there's a small platform from Singapore called TikTok. Have you heard of it?
No, never heard of it.
Brian, what do you think is going to happen with TikTok down in DC? Seriously, what do you think is going to be the move from the Senate?
Oh, I have no idea. I mean, it seems inevitable that they'll either be forced to sell in some form, and it doesn't feel like selling to the U.S. business alone makes any sense whatsoever. Spinning it off in the form of either an IPO or selling to shareholders or something like that feels way more likely. But I can't pretend to know what the Senate's going to actually do. It does feel, though, that there will be some change. The status quo, it doesn't feel tenable.
We can do some scenario analysis, though. The former president has made the point, some people believe it, other people have pushed back, that if you ban TikTok, there's only one winner. It's Meta and Mark Zuckerberg. Brian, is that how you see it?
No, not only one winner. I do think that Snap, for example, would be really well positioned potentially. Reddit would actually benefit on the margins, because if you think about where large advertiser budgets are going to go, they're going to look for new homes. To be sure, Reddit is not a direct substitute for TikTok. But to the extent that there's a lot of extra money flowing right now, let's be clear, we don't know exactly how much U.S. ad revenue there is. My assumption has been $6 billion. There was an FT article saying $16 billion US. That has to include e-commerce and other activity, not advertising. But $6 billion, if it had to find a new home, I think it's safe to say you could distribute it more or less along the lines of where the money is going today, right? So everyone who's a beneficiary, not just Meta, they would surely see a lot of absolute money, but I think YouTube would see a bunch of money. I think that Snap, Pinterest, and on the margins, Reddit as well.
Just to bring it full circle, the idea that Reddit priced its IPO at the high end of what people were talking about, is this a good time for TikTok to IPO? Is the IPO market basically telling some of these companies, now is your moment if you're going to do it?
If you've got an AI play, absolutely. And I'm not in the business of talking to investors on a day-to-day basis, so I don't pretend to know exactly what those who are bidding up the price are thinking at this minute. But I think that it's safe to say that there's a lot of ambiguous opportunity, let's just say, in terms of how their data gets used in AI environments. It could be a lot of money or maybe not. I don't know how you get to a robust valuation unless you assume it's going to be a lot, because it's not a terribly profitable business right now, as we've seen. Obviously, it can grow a lot, but that suggests to me that the willingness to look for the optimistic in the numbers is a sign of a very healthy IPO market. I guess that's the charitable way to characterize it.
Hey, Brian, we're going to leave it there. Appreciate the thoughts. As always, Brian Weeser there of Madison Wall on that Reddit market debut a little bit later on today. This is what's happening later on tomorrow morning. Coming up, Bob Michael of JP Morgan, Peter Oppenheimer of Goldman Sachs, Neil Dutta of Renmac, Mohammed Al-Erin of Bloomberg Opinion. All of that and a whole lot more, Bramo, tomorrow on Bloomberg Surveillance.
As we parse through what we heard this week, which is a change in the reaction function, I think that is our big takeaway, is that there has been a shift in the reaction function at the Federal Reserve, where growth doesn't necessarily mean inflation, and growth doesn't come in conflict with their goal toward 2%.
And that's something that's been developing for a number of months now, based on the communication from Chairman Powell. Stocks yesterday, all-time highs at the close. The opening bell about 35 minutes away, and guess what we're looking for? More record highs. From New York City this morning, good morning. This was Bloomberg Surveillance.
Welcome to a special Miami Open update for Bloomberg TV and radio from Tennis Channel. Former U.S. Open champ Sloane Stephens celebrated her birthday in style as she got past Angelique Kerber to reach the second round. After taking the opening set 6-2, the American took 4 games in a row in the second, closing out the victory after an hour and 10 minutes on court. Up next for her, Sorana Cristea. And don't forget, Tennis Channel's daily live coverage starts at 11 a.m. Eastern.